Look at this bar, very negative close. What happens the next day? We gap up. We don't close too well, but still an expectation breaker. And then the next day we have another gap up. So this is kind of like a compound positive expectation breaker before we break out and start that uptrend. So that's another kind of subtle clue to look out for, those positive expectation breakers before we change that trend. Because what's creating those positive expectation breakers? It's institutions accumulating shares, buying up that weakness, stepping on the bid, accumulating more and more shares. And they're not going to do that just for one day. They're going to do that for weeks and months. And that's what creates trends in the market. The core thing that we want to talk about here is the 4 stages that he identifies in the book. We've got stage 1, which is the basing stage, where there's chop up and down. Then we break out of stage 1, start trending above the moving average. That starts stage 2. That's when we want to be involved as traders to the long side. Then stage 3, things get choppy. Then we break lower. When we see this type of action where weekly closing range during a correction, when everything's pulling back, is greater than 40-50%, that's a suggestion of relative strength, and is something to look out for, because when the pressure lifts from the overall market, we can see a trend like this in Nvidia. A very simple way to determine the trend using a moving average is, are we above a rising moving average? Then we're in an uptrend. Are we breaking below and now trending below a declining moving average? We're in a downtrend. And just this, keeping it that simple, can get you engaged during the uptrends, because any entry here would have worked, right? And then getting you out as we break below, that would have protected you from this correction. Or again, if you're a short artist, this is when to be entering short during this period. But going long during uptrends, going short during downtrends or in cash, that's the way to go. And just using one moving average can, answer a lot of questions and confusion. On breakouts, we want to see enormous volume coming in. We don't want to have to sit here and think, was this above average volume? We want to see it on the chart, see explosion in price action. This is RKLB, as by the way, during its powerful move last year. As it broke out, you can see a surge in volume, and then it pulls back on lighter volume, suggesting that there's not really any sellers here. It reconfirms higher on higher volume, and then breaks out of another key base pivot level, again on higher volume. So this is exactly what we want to see. Breakout on higher volume, pull back on lower volume, reconfirmation up on higher volume, trending, just nicely, and then we get another breakout and push higher. So let's go ahead and get going. We've got a lot to cover today. First things first, this is kind of an outline of what's coming up next. We're only on webinar 2 of this, I think pretty much now 13 webinar series. Each of these webinars kind of covers one key chapter and key concepts that is from the Trader's Handbook, which is our debut book that's coming out May 27th. If you haven't pre-ordered yet, definitely go ahead and do so. We've gotten a lot of great response from people who have already done so. So go ahead and join those folks and make sure to grab yours today. And you can scan the QR code. The link is on that landing page. And we've also, of course, got the interest list where you can get additional bonus stuff if you do scan and sign up for the list. But I think pretty much everybody watching here today is already registered. Again, these are the webinars that are upcoming. Each of them covers kind of one key aspect of building a trading system. That's what this book is all about. And not only do we kind of provide the specifics about what we do for edges, for entry tactics, for risk management, setting stop losses, managing positions, all of that, but we also kind of just use that as examples to help you build your own system. Not everybody's going to trade like us. I don't trade like Rye. And it's kind of the principles that you can use to apply to build your own trading system, whether that's swing trading, whether that's even day trading, position trading, longer term active investing. This book will help you out and help you refine your existing strategy. So that's our goal with this book. Here's the QR code to join the Trader's Handbook list if you haven't yet. We've got a lot of bonuses and additional articles that get sent your way. Today I'll be sending out a reading price action guide, kind of covering how to read a single bar, what that means, how to set expectations for what's coming next. So that's sending out today. So make sure you join that waitlist if you haven't already. You can see also what else is coming. We've already sent these out right here. And if you do join the waitlist, you'll be sent those as well after you register. Here's the QR code again to register. And again, here's all the bonuses that you'll be sending. And we've got a lot of additional bonuses planned, things we haven't even announced yet. So make sure you sign up for the waitlist and also pre-order the book, because some of the bonuses are only reserved for people who have actually pre-ordered. So make sure to do that today. All right. So let's get into today's topic. Today covers chapter 3 of the Trader's Handbook. We'll be focusing on technical analysis foundations and also just kind of trading foundations, setting the stage for getting a lot deeper into entry tactics, edges, setups, all of that. Last webinar was really focused on the key principles, as well as kind of setting the stage for, the entire context of the book. This is the first webinar where we're really getting into the weeds and details and, setting the technical analysis foundation, which is kind of the language that we'll be using to talk through the entire rest of the webinar series and what's covered in the Trader's Handbook. All right. So here's the agenda for today. First, we'll discuss kind of from a very high level the purpose of technical analysis. I think there's a lot of misconceptions there. Then we'll get into reading price and volume, starting from a single bar and then building that up to short-term patterns. And not just memorizing short-term patterns, but thinking beyond the pattern and thinking about the psychology and what actually creates those patterns that we see here in the markets. Then we'll discuss tight areas and pivots, why they're so essential and useful. Then we'll discuss breakouts and pullbacks, provide some nice checklists of things to look out for you guys, and then discuss kind of at a very high level, but also at a very important level, the winning characteristics to look for when you're analyzing charts to basically find promising ideas. And this is kind of almost a preview of a lot of the edges that we'll discuss in the next webinar. And it's kind of, again, a high level view of what to look for to analyze supply and demand. Then we'll get into what drives market moves, some key factors to consider there. And then lastly, we'll wrap it up with the 3 opportunity zones, which are kind of the high level areas that we want to be focused on as traders to get momentum trends and moves and to catch on for the ride. So this is going to be a lot of fun. There's a lot to cover, so bear with us. And I think you guys will really, really enjoy this. So let's go ahead and dive right in. First, the purpose of technical analysis. I love this image over here. You've probably seen it all over social media at one time or another. And I think this is what people who don't trade or don't use technical analysis think is what we do. We draw as many lines as possible, and hopefully one of them respects price, or price respects one of those lines. And then we can say in hindsight, look what happened. I predicted it perfectly. But obviously, this is not the case. We don't have a crystal ball. Technical analysis is just a tool we use to help us manage risk, identify supply and demand, accumulation, all of that. And that gets into this slide right here. This is the real purpose of technical analysis. 1, to identify trends. 2, to determine accumulation distribution. Look for edges that we'll discuss today as well as in the next webinars. Spot repeatable edges and setups. Again, we'll talk about that more next webinar, and entry tactics in the webinar after that. And then lastly, well, actually not lastly, finding low risk entry points using those entry tactics. And then lastly, managing trades actually once we enter a position until our objectives are met. And basically the stock tells us that the trend is over, that's relevant for our time frame. So this is kind of the true purpose of technical analysis. And again, it's not about predicting. Raya, I know you love to say, there's no point in really, you don't even need to know what happens what happens next. It's all about just kind of interpreting what's going on in the moment, what's likely to happen, and managing your position as need be. All right, so let's dive in. And this may seem basic at first to especially more advanced traders, but again, we're kind of building from the ground up to have the same language and same context to interpret price actions. So bear with me for the first few slides if you're very experienced at this. First, looking at a single price bar. Put in the chat right now in the comments if you're watching this on YouTube, are you team candlestick or are you team price bar? Let's get some hashtag bars or hashtag candlesticks. Let's see what everybody is. All right, bars, candlestick. All right, a lot of candles. I'm team bar. I think Rye, you're team candlestick. So unfortunately, Rye, I'm going to have to kick you out of this webinar. We can just I'll handle it solo. But I think the real point is that it doesn't matter. They represent the same information, the open, high, low, close. And some people might interpret candlesticks that much easier. Some people like bars better. Just use what is comfortable to you. It's exactly the same thing. I first learned on bars. That's probably why I use them more. And candlesticks can be helpful and all that. Maybe when you're zoomed out on charts, you can see them a little bit better. But at the end of the day, they're pretty much the exact same thing. So just use what's comfortable to you. All right. So reading price action. Obviously, here we've got the open. Here we've got the close. This is the high of the day. Here's a low of the day. And what I want you to think about in terms of a single price bar is it's a match of tug and war between buyers and sellers. Buyers are trying to pull the stock up towards the high, and sellers are trying to push it back down towards the low. And the close and where this closes within the range from the high and the low basically tells you who's winning. Are buyers stronger or sellers stronger? And really it's buying pressure and selling pressure, because obviously for every buyer, there's a seller in the market. So basically, you want to think about this kind of methodology and the closing range, and how close the close is to the high of that bar's range lets you know who's winning this match of tug of war. So you can just kind of rotate this horizontally and kind of picture it pretty clearly that, this would be the center of the rope. The buyers would be up here, the sellers would be up here. And right now, clearly the buyers are winning. And this closing range, you can also, if you're, mathematically minded, you can just think about it mathematically. We have basically the close minus the low. So this area right here, and then we divide that by the high minus the low. So this range here. And the higher percentage value, because you just multiply this by 100, gives you a sense of where the bar is closing in respect to its range. So if we've got a high here of 100, the stock's at 98, and then the low here is at basically 90, you've got 8 divided by 10, and it's got an 80% closing range. So you can think about it pretty simply mathematically, but also just very visually. It's very intuitive to understand. Here, the buyers are in control. But in the same example, if we had a high of 100, a low of 90, and a close of 95, let me know in the chat what that closing range would be. Let's see how many quick math people we've got here. Let's see. Haven't seen any responses yet. We'll see. Nope, not quite yet, just yet. So again, the high is 100, the low is 90, and you've got a close of 95. 50%. There you go. Perfect. So again, that basically represents indecision. Buyers and sellers for that day are pretty much equal. And that's kind of how we want to think about what's going on behind the scenes when it comes to a price bar. We don't want to memorize, a hammer candle. What does that mean? You just have to kind of think about psychologically who's battling who in terms of buyers and sellers, and who's winning currently for that price bar. All right. And, DCR and closing range can be on a daily bar, it can be on a weekly bar, it can be on a 65-minute bar. It can basically be a helpful representation for any bar. And a daily closing range, we call that DCR, and a weekly closing range, we call that WCR. And here we've got an example of weekly closing range during corrections. This is a sign of relative strength. This is NVIDIA way back during the COVID correction. And look at the closes for the most part of NVIDIA during this correction. This is before it made I think 100% plus move in a short amount of time. During this correction, yes, it was falling pretty much every week, but look at the closes off lows. And when we see this type of action where weekly closing range during a correction, when everything's pulling back, is greater than 40, 50%, that's a suggestion of relative strength, and is something to look out for, because when the pressure lifts from the overall market, we can see a trend like this in NVIDIA. So this is how you can use weekly closing range practically. And of course, this way of interpreting things can work on the daily, can work on the 65-minute time frame. This is just a very simple application of closing ranges. All right, so another pop quiz here. What is this pattern called? Let's see who gets it here. All right. What's this pattern called, guys? And Rye, you can answer too if nobody gets it. All right, I see.
You won't like my answer, but
Oh, I want to hear your answer after you get it. Okay, I see some oops reversals. That's actually true. Downside reversal, Mike says. That's what I was looking for. Perfect. So it's not a bearish engulfing, because engulfing would have to engulf the entire day's range. But you're thinking about the right idea. So I call it a downside reversal, but really what I want to get across to you is, does the name even matter? Again, it's not about memorizing a sheet of patterns and say, this one's bearish, this one's bullish. It's about being able to interpret things at a higher and deeper level than that, right? And just recognizing that we had a strong bar here with a good closing range. We had the expectation that the buyers are in control. We have a gap up confirming that the buyers are in control, but then the sellers took control, and this closing range was right near lows and undercut and pierced a lot of the price action of the prior day. So we don't have to memorize this candle and recognize that it's bearish. All we have to do is think about what's actually going on behind the scenes. On this bar, the bulls were in control. We saw nice follow through to the upside on a gap down, But then what happened is the sellers completely took over and closed it negatively into this bar's range here. So just by interpreting it that way from a deeper level, we can tell that this is a negative, and the expectation might be fall through to the downside in terms of momentum. Now, Rye, let me know your answer. What were you going to say that
I was
about
gonna say
this?
it doesn't matter what you
Well,
call
there you go. There you go.
it.
There you go. Exactly
Yeah.
what the point I want to get across. Perfect. All right. Yeah, I see people call this bearish engulfing, dark cloud cover, all these different things. Squats, it doesn't matter. Just think about what's going on in terms of price action behind the scenes, and allow that to set your expectation about what could happen next. All right. And that's exactly what I say here. So short-term patterns, it's like I made this presentation. Use the closing range of the previous bar and recent price action to set an expectation of what could happen next. I'll read that one more time. Use the closing range of the previous bar. So this one, the closing range was good. And recent price action, we don't have recent price action here, but we'll have examples later on about how to incorporate that. And to set expectation of what could happen next. We had a gap up, which kind of fulfilled our expectation, but then this bar broke our expectations by closing negatively and not continuing that strong momentum. All right. Very nice. So this kind of brings us to the concept of expectation breakers. And this was coined, I think, by Mike Webster, definitely a great trader to learn from. I've taken it, and interpreted it my own way. Here we've got a negative expectation breaker. Here we've got a positive expectation breaker. And it's all based on what I, showed right here. Here on this bar, we had a strong bar, a good bar that closed near highs. What would be the expectation for the next day? It would be to maybe fall through to the upside and continue on with the positive momentum. Instead, what happened is we had a gap down, and gaps are very significant. That's something you want to key in on, and that's how market wizards really look at charts. We had a gap down and fall through to the downside, completely breaking the expectations in a negative way, hence why it's called a negative expectation breaker of what was going to happen based on this bar. And then we've got the flip side here. Here we've got a very negative bar closing near lows. The expectation would be fall through to the downside. Instead, what happens is we get a gap up, breaking those expectations, and a strong close and hold. Basically, suggesting that we might have a short-term momentum change to the upside now. So these are expectation breakers, both of them. And the more you learn this concept, you'll start to see these all over the charts at key turning points. And it can happen right before we enter a correction. It can be at the bottom of bases, really confirming the low. Just study history and you'll see these all over the place and really recognize how powerful they are and how significant they are. In the model book chapter of the Trader's Handbook, chapter 12 is a model book chapter of 200 plus annotated charts. I point out a ton of expectation breakers at the bottom of bases right before a stock enters a correction. And the more you notice them, the more significant they become. And it really helps you interpret things and be on guard and just be a little bit more aggressive, both with entries as well as exits, to just get a little bit more performance. So these are really important patterns to be aware of. But again, even though I'm naming them here, you just have to think about what's going on behind the scenes. You don't have to memorize that there's a negative expectation breaker. You can call it whatever the hell you want. Just kind of think about what's going on. We had a strong close. The expectation is that we'd follow through. Instead, we gap down and fall through lower. Here we have a very negative close. The expectation is we fall through to the downside. Instead, we gap up and fall through to the upside, breaking expectations and leading to a short-term momentum change. So this, I think, is a really important concept and one of the most important things I wanted to cover today. So hopefully you guys find that helpful, and let us know in the chat. All right. Another short-term pattern that obviously is very common, but is worth going over because it's, again, something that market wizards and top traders look at, is inside days. And what is an inside day? It basically means that the entire bar's range is contained within the bar's range from the day before. And it basically just means that there's some type of consolidation, contraction, and volatility. And from these type of patterns, we often get explosive move to the upside or downside, depending on the situation, depending on the market, depending on the stock, and of course the overall pattern. But inside days can be a really good entry tactic, and we'll get into that in future webinars. And it basically, one of the reasons it's good is because if we get a move to the upside, we've got a strong close here. The expectation would be a move to the upside. You can manage risk really tightly at this low of the day. And of course, we'll get way more into that in the entry tactics webinar, but that's one reason that the inside day is really good in the context of a mature overall pattern, strong stock, all of that. We always want to consider the overall context of short-term patterns. That's really, really key. Then we've got an upside reversal. Again, I'm naming these, but you just have to kind of think about the methodology and thinking behind them. We had a negative close, we fall to the downside, but then we get a short-term momentum change and have a strong close. This can be a really good entry tactic as well. Through this low, that's called an oops reversal. We'll discuss that in the entry tactics webinar. But again, this is just another short-term pattern that can represent a short-term change of momentum, which is basically what an entry tactic is and what exactly we're looking for. You can manage risk really tightly at the low of the day here, and ideally have a nice profit going into the close. And the best upside reversals turn into outside reversals, where we don't just follow through and enter the prior range's bar very nicely. We actually overtake the high of the prior day's range. And this is a significant change in momentum. And if you entered through this low, you're at a healthy profit and can potentially ride the trend that comes after this setup. All right. Short-term patterns. So again, what is this called? Let me know in the chat here. I think there's a common name for this one. And maybe you have to think about it in terms of candlesticks. Let's see what people say. All right, I see the answer here, but again, the answer is it doesn't matter. Just forget it. Again, what is happening here? We have a strong bar, a strong bar, a strong bar. Just looking at accumulation. You don't have to name this. You don't have to memorize the pattern. Just interpret it every single day. The stock made progress. That's all you have to kind of think about. All right, then we've got this one here. 2 strong days, negative expectation breaker. Again, a potential change in momentum, short-term momentum. Maybe this was a failed breakout that then falls and resumes to the downside. This is something to be aware of. And this is, again, a kind of key thing I want to talk about. How do these patterns interact with key levels? Key levels are basically spots on the chart where they're significant to many players in the market. This could be a base pivot. This could be a high volume close from an earnings gap. This could be the low of a base. Basically, these key levels are often where short-term momentum changes happen, and we want to respect them and really pay attention to short-term patterns at these key levels and areas. Here we've got a range that forms, a breakout, but then what happens? The buyers weren't strong enough to follow through to the upside and actually lead to a successful trade, and we get a gap down and close lower. This would be a failed breakout and definitely a sign of weakness, especially considering where it happened near this key level. Another key concept I want to talk about is considering the context behind a short-term pattern. Here, of course, we've got an inside day. We have fall through to the upside through this high. But what is the overall trend here? What's actually going on? And is this actually something that's very positive that will likely lead to a move higher? Not necessarily, right? It's still within this bar's range. It's barely progressed since this high, and the overall trend is down. So that's what considering the overall context means. And of course, you can use moving averages, a higher time frame to consider this. But really, the most important thing I want to talk about is don't just think about an inside bar as a completely bullish thing without considering the overall context, because here an inside day doesn't really mean much. It is maybe a pause in the downside momentum, but it doesn't necessarily mean that we're going to explode to the upside and everything will be great and we'll start an uptrend. Always think in terms of the overall context of the chart pattern. And here's how, obviously, this is probably basic for many of you, but this is how different patterns emerge on multiple time frames. Here we have the weekly view. This is the daily view of basically the exact same pattern. We've got a very negative down bar and then, basically a pause. There's not much fall through to the downside, but not really any momentum to the upside. And we see the exact same thing on the daily view, large selling bars here, and then maybe a pause and the potential for a move higher, but nothing sure yet. And overall, the context is negative. So that's how you can kind of interpret things on both a weekly and daily basis. And it's really helpful sometimes, especially I think as traders, we get sucked into intraday timeframes. Just zoom out to the weekly and think about what is the overall trend? What is the overall context? Does this stock look like it's being accumulated or distributed? This is really, really important and is really key to making sure you're trading with the longer term trend in mind. All right, so this is a key concept that I really want to focus on and communicate to you guys both in these webinars as well as in the handbook. And this is the concept of priming a range. And this is really the whole point of short-term patterns and entry tactics, is looking for patterns within overall mature setups that let you know, hey, really focus on this stock and have it on your daily focus list for the potential for the start of a trade. And what I mean by that is basically inside days and upside reversals, two short-term patterns that we talked about. When they're in, on the right-hand side of a mature pattern, whether that's completing a handle and a cup and handle, whether that's a pullback to a moving average, they basically prime a setup and say there's potential for the start of new momentum. Here we've got an inside day within a range, and a break through this high actually completes this overall higher time frame pattern, or larger context pattern, and entering here allows you to manage risk either at this low of the day or the low of this bar, and getting in before everybody else is trying to jump in the stock. And here you can't manage risk nearly as tightly to the low of the day. And that's kind of the benefit of a short-term pattern that can prime the range. And then very similar here, we've got an upside reversal. And here we basically have a range that forms. Again, there's a clear pivot to the upside. We have an upside reversal, and then we break out through this high this next day. You could enter versus the low of the day here, have a great profit as it already tests this buy point, and then we fall through to the upside. So these are kind of two examples of priming the range and saying, hey, if you see the stock on this day in your weekly or in your daily routine going through your screens, that's when you would say, hey, it's got an inside day. Maybe it's ready to go the next day. I'll put it on my focus list and be ready to execute because I know it can manage risk. And it's got the potential for a nice momentum move that will get me out of profit immediately. And if it fails very quickly. You can manage risk very tightly, and it's just a paper cut. That's kind of the benefit of both an inside day and upside reversal. Is likely there's a short-term momentum change, and you just have to be ready to take advantage of it. And in the chat right now, I want you guys to put in the chat, why is the upside reversal almost better than the inside day in terms of priming a setup? And just a hint, guys, we've got these lows here. How are those relevant to this upside reversal, and why that might really signal that the stock is ready to break out of that range? All right, let's see what you say. All right. Shook out weak holders. There we go. So I see a lot of shakeouts, shook out weak holders, and you're exactly right. Say, this day, a lot of traders entered and they were trying to kind of anticipate this breakout through this high. If they entered on this day, where is their logical stop? Their stop is probably at the low of the day. What happened the next day? We gapped below that level and then pushed through it. All those traders who put their stops here or entered on this day and put their stops here, they're stopped out on the open. It shook them out, and then the stock reversed back upwards and started upward momentum, exactly what they were looking for. And they have to buy it back because they want to be in the stock, and they got shook out. And that buying pressure, again, pushes the stock higher and might push it out of the overall range. So that's why this upside reversal, I really like these setups, and they happen a lot in the best setups, upside reversals right before a stock actually breaks out of a range. So both inside days that represent contraction and upside reversals that represent short-term shakeouts are really good to prime a range. That's a key thing I want to get across today. All right. Short-term patterns. So again, this is just kind of summarizing this section here, the key points here I want to make. One, consider the context. Always consider short-term patterns in the context of the larger setup, the larger context of the market as well. We'll of course talk about setups and edges a lot more in the next webinar. Then think about, are we expanding or contracting? Have we made a powerful move already and this is just a pause? Or do we have the potential for a nice momentum surge the next few days? What is the prevailing trend? Think again about the larger context. Where are the key levels, base pivots, moving averages, all of that, everything that's relevant to the market. What does the higher time frame look like? Again, if you're focused on daily charts, think about what the weekly chart will look like and whether we're extended on that time frame as well. That can help you let you know if there's still potential in the stock. And then lastly, based on the closing range and recent price action, what is your expectation of what could happen next? This is really key here. This again, think beyond the pattern, think beyond memorizing this is bullish, this is bearish. Just think for yourself about what's going on in terms of supply and demand, buying pressure and selling pressure, and think about what is likely to happen next. And if that happens, you're correct, you could execute on that. And if it doesn't happen, that's also valuable information that you can take into account and lets you know that maybe, the buyers weren't as strong as you thought. The sellers maybe are taking in control, and you can manage risk a little bit faster, or take profits faster, or enter a short maybe a little bit quicker than other traders who are waiting for more follow through and more context. So that's kind of the benefit of short-term patterns. And hopefully this section was helpful for you guys. All right. So volume analysis, let's get into this as well, Ryan. I want to hear how you use this as well. Um, we talked a lot about price action and closing ranges and what bars are doing. How does volume come into play as well? Because I think it's a key thing that you should have on your charts. I think price and volume action are the most important things. And very simply, volume adds weight to what price is doing. And you want to basically watch for significant volume or very low volume. And how do you determine significant volume or very low volume? You can basically use a moving average. I like to use a 20 period moving average on my volume. You can also compare a single bar to the recent bars. There's people who call that pocket pivots. You can do a 5-day pocket pivot or a 10-day range and just say, is it higher than the recent volume? You can keep it very, very simple. But basically, on breakouts, we want to see enormous volume coming in. We don't want to have to sit here and think, was this above average volume? We want to see it on the chart, see explosion in price action. This is RKLB, as by the way, during its powerful move last year. As it broke out of a base level, I don't show the base pivot here, is quite a ways away. As it broke out, you can see a surge in volume, and then it pulls back on lighter volume, suggesting that there's not really any sellers here. It reconfirms higher on higher volume, and then breaks out of another key base pivot level, again on higher volume. So this is exactly what we want to see: breakout on higher volume, pull back on lower volume, reconfirmation up on higher volume, trending, just nicely, and then we get another breakout and push higher. And Ryan, thank you for kind of recognizing and showing all this. And this very low volume during a pullback is really key. And you don't have to memorize this. It's just about thinking about what's going on. As the stock is pulling back, if it's drifting down on lower volume, what is that telling you? It's telling you that there's not really a lot of conviction in the sellers, and really it's just a lack of demand that is basically leading the stock to not increase in price. And if there's no selling pressure, likely whenever more buying pressure comes in, the stock is going to continue the trend that started with the breakout. So Ryan, I know you really focus in on tight price action with low volume, especially when a stock entered a RS phase. Anything you want to add to this slide here?
I would say try to work and look at previous winners in the markets and how they kind of pull back. In real time, it gets tougher when you haven't kind of done the chart work and looked at past, we're looking at this RKLB, which doubled and then some in a span of 18 weeks or so, right? So this pullback, even if you got in right here, it gets tougher to hold, even though the volume is low. But then, that good stocks pull back on low volume that allows you to hold, and then the moving averages kind of act as psychological support as well for you to write out what is about to happen. So it's super important to get a whole bunch of reps in where you see these situations play out again and again. And eventually you'll get to a state where the name on the chart doesn't really matter that much. When you're purely focused on price action and volume, you'll see patterns repeat themselves again and again. Then later on in your trading career and things of that nature, like once you've mastered the technical analysis side, then there's a whole thing where you can master catalyst, news, what the company does, how you can interpret that. Is it a successful blueprint of a company that has had, um, is about to grow in terms of earnings and things of that nature as well. So really go, bar by bar analysis, just you put, any winner when um, even if you know that a stock is now, has doubled and then some and you're kind of analyzing it, just try to, maybe take screenshots, place them in a Google Doc, print that out, and then you won't really know the situation other than the price action and volume. And you can shuffle that and really go bar by bar, trying to anticipate what may happen next as well. So I think it's important. It also ties into what Richard's been talking about with expectation breakers, and how I see expectation breaker right there. I'll probably point it out
Yeah, I
right
was actually going to
here.
lead them through. Oh yeah, there
Yeah,
as well.
yeah,
Let's start here, guys.
yeah.
What do you see with this bar right here? And what does that tell you in terms of supply and demand? This is before the breakout. What do you guys see here with this bar? All right, I see shakeout, reversal, weak hands shakeout. Perfect. So this doesn't mean that it's buyable right away, but it's all about collecting evidence. Ryan, you taught me how to think exactly like this. Just because you see a shakeout doesn't mean it's buyable. We're still in a downtrend. We're below the moving average at this point. but it's the potential for a significant higher low or low of the base, whatever. And what happens next? We basically tread water sideways for a few bars, then gap up. Again, gaps are super significant. Then what happens? We drift lower, and let's see the volume on this drift lower. So we've got a really low day right here. Sorry, I want to zoom in, but also look at the volume, and we'll go back and forth. We get a really tight range, an upside reversal bar here, very tight bar, and this is the bar where there was really low volume. And this is something that Leif Serede, the U.S. investing champion of 2019, taught me, is to look for very, very low volume, the lowest volume in about 10 days. And if there's very low volume with tight price action in a stock that's showing potential, there's the potential the next day for a nice explosion here. And this would be a way to enter through this high before the actual breakout. And then you get fall through upside. And then we get this pullback. As we talk about, this happens on lower volume. And then this is the shakeout and expectation breaker that Rye was talking about. Look at this bar. Look at how many lows this undercuts. What's your expectation if you look at the chart on this day? Again, ignore the rest of this price action here. What's your expectation after this bar? Probably a fall through down to the 50 SMA or even down the 200 SMA. It looks like it's breaking lower. It failed this breakout. What happens the next day? Instead of breaking down lower, we gap up and close strongly. It just changes your expectations right there. That could have been an entry point where it shook out all these people. And it's kind of like a almost compound 2-bar upside reversal where we shake out lower and close strongly. But even if you don't enter on this bar, what happens the next bar? What is this pattern called? This is an inside day. So again, it's like contraction after expansion, and it's telling you that there's no selling pressure whatsoever. If you look at this bar here, what's the volume like? That looks like the lowest in quite some time and much lower than the average, right? And what happens the next day? We get the explosion higher. So these are the nuances that market wizards and top traders look at and are interpreting every single day as they're looking to decide what stocks are on their focus list, what has the highest potential for a powerful move for swing traders or position traders the next day. And yeah, that's the buy point. You could even use the high of the inside day here and manage risk really easily at the low of the day here. It breaks out through all these highs in this entire range all at once, moves higher, contracts again against the moving average. What's this bar here again? Upside reversal. And it shook out below this low, closes strongly. What happens the next day? We get a breakout. You don't want to enter up here where everybody's watching it and you can't really manage risk tightly. You want to enter close to this high using your stop at the low day or maybe the 10 EMA down here and have a great profit that enables you to hold going forward during this trend. And even going forward here, look at this bar. That's telling you there's demand, that even after this powerful move, we're not done yet. We're holding the 10 EMA on a closing basis. We had a gap down that closed strongly. We enter another range here. We have another upside reversal on the 10 EMA, again suggesting accumulation. What's this bar right here? Inside day. Let's take a look at the volume. Very, very low volume. So as we're contracting and forming a range after an expansion higher, a powerful move higher, we're seeing a pullback and tightening of ranges on very low volume. What happens the next day? We get an outside reversal where we undercut this low of the inside bar and close strongly above that high. That would be an entry point. And Leif actually bought this on this day. This is exactly what he looks for. And we get an expansion higher. And again, this allows you to enter before this base pivot with tighter risk. That's almost the most important thing. It allows you to enter at a point where you can manage risk very tightly. And if this bar, for instance, the next day reversed lower, you'd be stopped out for a very minimal loss, but it gives you a chance to capture this type of trend. And throughout this move, this is definitely a move we're studying, and we include this in our model book. And the high tide flag model book we're doing with Leif as well. There's so many inside days before the expansion moves up. There's so many shakeouts before expansion moves up. These are things that you want to pick up on so you can recognize them in real time, and you have to study them and look for those tight areas on very low volume, and you'll just start to see them all over the place. You'll start to see shakeouts and be able to anticipate and expect what can likely happen next better than other traders, and that's what gives us an edge in the market. So again, just look for tight areas, shakeouts, low volume right before explosive moves. I think there's a great example to study very closely, go bar by bar like Rice said. I like to do it where I don't see the price action going forward. I just kind of say, after this bar, what's my expectation? And if I did that over here, My expectation would be you hold a 10 EMA. That's a negative bar, but it's pull back to the pivot. What's one more bar? Not much follow through to the downside. What's one more bar? Fade off highs, negative, still kind of weak, still watching for undercut of this level. Not much of a change. Again, a fade off high. Oh, yep. Might fall through to the downside, break this low. Oh, okay. It was supported at that level again. All right, inside bar, but closing near lows, might fall through to the downside again. Watching these lows here. Oh, there we got the shakeout. This is the shakeout bar. Very negative. All these people were stopped out if they were trying it. Might take this off my radar. Oh, broke my expectations. Reclaim that level. All right, I'll put it back on my watch list and watch for fall through to the upside because I know a lot of people are stopped out right here. All right, very tight day. The setup actually got a lot better. The setup is primed now. We've got a powerful move. We've got a pullback on low volume. Shook out a lot of traders. Now a tight inside day. Boom. That's where you enter the swing trade, position trade, and get a great cushion before, with very minimal risk and are able to ride this trend. So that's how to use the short-term patterns we're talking about and how to actually apply the concept we're discussing. And hopefully this walkthrough was pretty helpful. And let me see how to get back to the next slide. There we go. So again, study this whole RKLB chart because as it's breaking down as well, sorry, let me zoom in one more time to show the flip side. Because I was looking at this for entries here because it had just broken out to all-time highs. This is a positive expectation breaker, great move. This would have been a great first swing trade and a great entry. And it looks good. Oh, but then we've got a downside reversal. Some fall to the downside, but holding the 10 EMA. Still holding the 10 EMA. Looks okay. It gets tight, still holding the 10 EMA. And it was tight for quite some time. Then we get a gap up that's supported, still looks okay, but kind of failed this breakout. Probably you'd be out if you entered on this bar. And it just starts kind of breaking expectations. And there's all these closes and fades off high that say, sellers are kind of in control each day, even though it's not making much progress. And it tries to break out again, but can't hold it. And this is telling you a lot of warning signs before we start breaking lower. All these fades off highs. This tries to go, reverses back down. No follow through. That's a key thing that Oliver Kell looks for is follow through to the upside. This one didn't. It just reversed back down. And this is happening way before it starts breaking below moving averages and gives you a heads up to say, hey, it's not quite acting right. It's not meeting my expectations. I'm going to be watching very carefully or maybe even take off half my position to protect myself. And this happened before we break lower. And again, breaking below all these lows at once, very negative, and then we get follow through to the downside. So that's kind of a great example of both the positive we saw earlier and then the negative side where you'd want to be taking profits or just being a little bit more defensive here. And then we get a big demand bar, so potentially the start of constructive action. We're still well below the moving averages, need to build another base. But that's a good example of the other side of the situation as well. Sell rules using the short-term patterns we're talking about. And again, it's not memorizing that this bar is negative. It's about taking everything in context. Here we get a strong bar, then we reverse down lower the next day. You don't have to memorize that this is negative. You just have to kind of read it bar by bar using what's going on behind the scenes to let you know about what's going on. Right, anything to add based on what I just said? Oh, you're on mute.
I I think the key takeaway is, doing that bar by bar analysis. A lot of people in the comments really liked the fact that you walk them through that.
Yep.
And this exercise of going and doing this by yourself will really help you out. I think the key takeaway here is, when it breaks the multiple lows and your expectation is that something's going to continue lower, and that doesn't happen the next day or the day after or the day after, right? You have to shift
Yep.
and the market's telling you something different. And a lot of people get stuck with, hey, it stopped me out once. It's one of the hardest things to do is to buy back something that you lost money on. But if you know it has the volume characteristics and the trend and the theme and all of these things that we'll speak about, you kind of have to buy it back if you want to be in the best stocks in the markets at times. So
Yep.
I really like the break of the multiple. There's a lot of psychological factors at play when we break 5 days of lows in one go. That leads to a lot of volume. Momentum is created through volatility, essentially, and volatility is created through, plowing through a bunch of stops at once, which creates a lot of, indecision, panic, don't know what to do type of situation. that leads to directional moves in the markets, be it to the downside or the upside. The only difference in RKLB in this situation and this situation is that on this day, when we expected that flush, if we got an expectation breaker here, things would have changed
Yep.
right away. Whereas on this flush, yes, we did get an expectation breaker and we get a trend. On this day, we got to follow through to the downside, right? They're very similar situations, even though the volume profile is much, much better over here than it was over here because there's a lot of churn,
Yep.
because the volume is also above average in this range, right? So that tells you, too much sideways action with accompanied by high volume or average volume or above average volume likely will not resolve to the upside. Whereas, there's a lack of sellers right in this area. There's no interest to come in and sell a whole bunch of stock, whereas this is taking its time where it's being sold into. There's a whole bunch of expectation breakers right here to the downside, which leads to the eventual trend. Whereas, there's rapid volatility when we break the 50-day and things just flush all the way down and you move 20, 30% in a matter of 2 to 3 days, or 2 to 5 days. So
Yeah, I see some questions. So by the way, this is the 10 EMA, the shorter moving average. The 21 EMA is the purple line. The 50 SMA is the red line, and the black line is the 200-day moving average. But I know, Rye uses slightly different moving averages. It's more about price and how it's building, and that's really what we want to get across here. And I think another difference about this situation, exactly what you pointed out, the churn, the fades off highs overall here, is, this base we try to break out and couldn't make any progress. This is a strong bar that should have followed through. I mean, look at the volume. The expectation is follow through. Instead, we just churned and couldn't make any progress. Here we had recently broken out of a pretty big base. This pivot I think is around here, and this pivot is like around here. So it was just starting its move here. Here it's trying to form a continuation setup after already moving, I think, like 400%. So it needed to follow through here, and it didn't, and just churned. And looking at the closing ranges, looking at bar by bar analysis, that informs you about when stuff is going, happening on schedule, acting normally, all of that, versus when it's not, like we saw back in this area. So you're ready to protect yourself during this decline. Or if you're a short artist, this is a great entry point, or on the fall through to the downside. That's kind of how to use this to the short side as well. And then, Rod, just to echo what you said, this bar by bar analysis is the best practice you can do of top leaders. And in Deep View, by the way, we've got in the watch list section presets of the model book stocks from previous years. You can go back to those time frames, go bar by bar, and see how things develop. See the setups, and you'll see the same setups, same patterns happen all over the chart. Inside days before breakouts, upside reversals before breakouts, respects for moving averages. And the more and more you do that practice of going bar by bar, the better you're going to be able to do it in real time during your routines and get a sense for what that stock is going to do. And then as a whole, what the market is likely to do based on how all the stocks are acting and setting up. So that's why this analysis is so helpful. So glad you guys picked up on that. Also, yeah, please put any questions in the Q&A section here. We've got a lot to cover, so we've got dedicated points in the presentation where we'll answer questions, but definitely put any questions you have in there as well. All right. And by the way, yeah, we go through all these concept closing ranges in the book. Everything's explained there as well, in a different way. Some people are visual learners, which is great. Webinars are perfect. Some people like to have a resource that you can refer back to over and over again. And also a great way to study winners and go bar by bar is to study the model book section, the model book chapter of the Trader's Handbook. That will be a great way to look at winners from the past 10 years. We put so much in there and pointed out the key characteristics for you. So that's another great resource for you. All right. Moving on, let's talk about determining trends, because we've talked about short-term patterns, how they can expand. But again, the larger context, the prevailing trend is so important. And there's two main ways to determine a trend. They're both pretty easy, but depending on how you like to view price action, you might favor one method or another. The first is probably the most common, just using a simple moving average. And I said simple moving average, meaning just simply using a moving average. This is actually the 21 EMA. That's kind of if I had to use one moving average, the 21 EMA would be it. But anyway, a very simple way to determine the trend using a moving average is Are we above a rising moving average? Then we're in an uptrend. Are we breaking below and now trending below a declining moving average? We're in a downtrend. And just this, keeping it that simple, can get you engaged during the uptrends because any entry here would have worked, right? And then getting you out as we break below, that would have protected you from this correction. Or again, if you're a short artist, this is when to be entering short during this period. But going long during uptrends, going short during downtrends or in cash, that's the way to go. And just using one moving average can, answer a lot of questions and confusion. There's so many people who try to catch this bottom and we're below the moving average, and then you get stopped out. You try to catch this reversal, anticipating a breakout. We're below the moving average. Just listen to the price action and listen to that prevailing trend. It's so, so important. And then we flip here to, again, another uptrend very early off the bottom here. And this obviously led to Tesla's 2,000% move or something crazy over the next year and a half here. So just using that moving average can be very, very helpful. So here is the uptrend above the rising MA, downtrend below the declining MA, and then the new uptrend above the rising MA. And by the way, what happened right here? That looks like an inside day right before we start this momentum move up. So again, and this, by the way, is where Oliver Kell was buying his position, and Tesla was a huge reason why he had those record-breaking returns in 2020. And this setup where we just broke back above the moving average, just formed a higher low, set up an inside day. This is where he was establishing his position right in this area, his core that basically won him the USIC for that year. All right, so that's using a moving average. Very easy to do. The second way is to just use market structure, the definition of trend. What's the definition of an uptrend? It's higher highs and higher lows. What's the definition of a downtrend? It's lower lows and lower highs. And how do you determine, which lows and highs to consider? Basically, you want to look at points where we moved up for a few bars and then moved down for a few bars. And then this becomes the relevant swing high. And similarly for a swing low, we look for a place where we moved down for a few bars and then moved up for a few bars. And that becomes a swing, this is the swing high, and then this is the swing low that you want to consider. And again, we move up, reverse down. This is a swing high. This is a swing high. This is a swing high. This is a swing low. You can just look at kind of local mins and maxes if you're kind of a math brain guy or gal. Again, this is obviously a significant high. Look at this. Expansion higher, reverse back down. Clear swing high here as it reverses down. So you'll kind of know if something is a swing high or swing low by looking at price action kind of 2 days after. And if it's a kind of a local max or min, then it becomes a relevant thing to consider based on market structure. So with that said, now we know how to do a swing high. Here are they kind of labeled here. This is a higher high, this is a higher low. Again, higher highs and higher lows all the way up into this point. And then what's this? This is the first lower high. And that's the first sign that the trend may be transitioning from an uptrend defined by higher highs and higher lows, transitioning to maybe a base or a downtrend. We get a higher high, another higher low, a lower high now. Oh, what's this? We broke below this higher low and formed a lower low. That's the start of the downtrend. We get a lower high, another one after this one. And then we just see lower highs, lower highs, lower highs, lower low. There's not even really a pause here. This might be a lower low as well, but there's not really a pause here to define another lower low until this point. And then what's this? Oh, we get a lower high. We form down. This would be another, higher low, higher high, higher low. So we've transitioned back into an uptrend, and then this breaks through that higher high. So this starts the uptrend. So it is kind of color coded, and you'll notice that this basically lines up with exactly this. So there's a reason that it lines up. It's because it's just two different ways to look at price action, one based on swing highs and swing lows, and one just using a simple moving average. I think if you're a beginner trader, just using the moving average is probably a good way to start. But if you're more advanced and want to catch stuff and start noticing, this is the first higher low, anticipating this break higher into a new uptrend, using market structure can really help you, have a step up on most traders. And by the way, look at this bar, very negative close. What happens the next day? We gap up. We don't close too well, but it's still an expectation breaker. And then the next day we have another gap up. So this is kind of like a compound positive expectation breaker before we break out and start that uptrend. So that's another kind of subtle clue to look out for, those positive expectation breakers before we change that trend. Because what's creating those positive expectation breakers? It's institutions accumulating shares, buying up that weakness, stepping on the bid, accumulating more and more shares. And they're not going to do that just for one day. They're going to do that for weeks and months, and that's what creates trends in the market. So those patterns that we've talked about, again, think beyond the pattern. It's all because of supply and demand and big institutions deciding that we need to accumulate Tesla because they're changing the world in terms of EVs and the prevailing theme, the leading theme during this time. So I'm getting ahead of myself, but yeah, this is how you define trends based on market structure and moving averages. Ryan, anything you wanted to add on kind of how you look at trends, determine them, based on either way to do it?
I think the slope of the moving average for me is pretty much,
Yeah.
how I determine trend. So if the slope of the moving average is to the upside, I know that for, let's say if we take the 21 day, the last 21 days on average, the trend has been, or the closes have been to the upside, right? And if the slope of the moving average is to the downside, it means that there's a lack of momentum, a lack of momentum to the upside, and then price is likely going to come in or be pushed lower below the moving average. So keeping it that simple, really, I like what you said with how the higher low and the higher highs kind of align with a moving average
Yep.
as well. Moving averages just make it a little bit easy. But I think it's also important to go through the other exercise of, labeling those so that you really understand as to what a moving average is really trying to represent at the end of the day. So.
Yep, perfect. And then just to emphasize the point we were making early, look at this downtrend, look at this negative bar. What happens to the next bar? This is a positive expectation breaker. This is a very negative close. We gap up, tries to push lower, but we can't. We hold there, and they stamp on the bid and close this up very high. And this is the potential for a base low. You don't know until it kind of confirms later and restarts the uptrend. But this is the subtle signs that you want to pick up on so you're ready for when the trend actually changes and you have Tesla on your radar. We have a strong bar, upside reversal. We try to roll over and we can't. Then we gap up. These gaps are really key. We've put in a higher low. Again, positive expectation breaker. These are the subtle things that top traders look for to anticipate and be ready for when their setups and entry tactics appear in the market in a promising stock. So that's why we're really focusing in on them and saying them again and again because it's really key and will help you as a trader. So that's why we're emphasizing them. All right. So taking a step back here for a minute, we've talked about how important the larger context of everything is. And I think the best way to get larger context is to incorporate the stage analysis methodology. So stage analysis was obviously developed by Stan Weinstein. We've done a masterclass with him. That's where this graphic is from. And I think Ryan and I both.
It is.
Yeah, yeah,
It
yeah.
shows, but
Yeah,
yeah.
we just did a stage analysis model book with Stan as well, and both Ryan and myself, I think, were on the phone with Stan for hours and hours, making sure we got all the nuances and stuff for the masterclass correct, and we learned a ton. But just reading that book will be excellent learning for you. There's a lot of key points that he makes that are excellent, and the core thing that we want to talk about here is the 4 stages that he identifies in the book. We've got stage 1, which is the basing stage where there's chop up and down. This is a weekly chart. This is the 30-week moving average. You could also use the 40-week moving average. Again, it's more about how price is building. These are just reference guides. Then we break out of stage 1, start trending above the moving average. That starts stage 2. That's when we want to be involved as traders to the long side. Then stage 3, things get choppy. Again, almost like a flip side to stage 1, where we don't make much progress to the upside. And start oscillating above and below the moving average. Then we break lower and look at this. Higher highs, higher lows during stage 2. Then during stage 3, we get chop and there's some higher highs, there's some lower highs, there's some higher lows, there's some lower lows, and then we break below the moving average. And again, it's lower highs, lower lows, and we trend below the decline moving average. So just using the weekly longer term moving average can help you identify the stage. And we want to be going long and be involved as traders to the long side in stage 2 and be exiting in stage 3 and maybe even going short or definitely in cash and definitely exiting in stage 4 to the long side. So that's how to use the 4 stages. And this provides a great framework to think about the larger context. And I think, most investors, I think, go wrong because they don't listen to longer term trends. And they're trying to go long in stage 3 when the news is best and things are, the company's innovating the best. and then they hold on during all stage 4, and maybe it comes back and forms another stage 2, but it's kind of up in the air. So we want to be involved when all the longer term trends are with us, and be exiting when the longer term trends turn shower. So this stage analysis, really important. If you haven't studied this methodology, we've got videos with Stan, we've got the masterclass, and we've got the model book that I think we just released yesterday. So definitely pick that up if you haven't already. All right. So here's an example. This is NVIDIA. We've got the 2020 stage 2. This is almost a stage 3 that reconfirms into a stage 2 because that can happen. But then we have a very short stage 3. We enter a stage 4 decline below the moving average. This is the 10-week moving average, this red line. This is the 40-week moving average in black, basically the 200-day moving average. And we break below it, have a stage 4 decline. It declines 70% from highs during the stage 4. And then we start to see a stage 1 base. This is also an inverse head and shoulders. But again, you don't have to think about the names of things. You just have to think about, all right, we were lower highs, lower lows. Then we have a higher low. And then we have a higher high. And also in terms of moving averages, we were below all the moving averages. We reclaim the 10-week moving average. We undercut a little bit, reclaim it. A little bit of an expectation breaker here. We thought we'd roll over. We reclaim the longer term moving average. And then we break out to the upside. So you don't have to think about inverted head and shoulders. You just have to watch what price action is actually doing. And we break out, begin a new stage 2, and are potentially forming a new stage 3 right here. Actually, I was going to ask you guys what stock is potentially in stage 3 right here, but I forgot. But to ruin the surprise, potentially NVIDIA, and we'll see if it rolls over or holds here, because stocks can transition from a stage 3 back into a stage 2 uptrend. But you got to be on guard when things get choppy. We all oscillate above and below the moving averages and are potentially forming and rolling over. So we'll have to see how NVIDIA resolves, and maybe in the future when you're watching this, you'll actually know whether we restarted a stage 2 or began a stage 4 decline. So any questions on stage analysis? Let me see if there's any questions. And Rai, call out if there's anything you saw. Yeah, stage 4 is trending below the moving average. Exactly. All right, perfect. All right, so let's keep moving. Within a stage 2 uptrend, there's going to be pauses along the way. And these are what we call bases or consolidations, again, whatever you want to call them. And you can use them to kind of track how long the trend's been going on. This is a weekly chart of ELF, a key leader back in the 2022 to 2023 area. We had a stage one in terms of stage analysis. We break out into a stage 2 uptrend above the moving averages. Look at how it respects the 10-week moving average, this red line throughout this. And then you can see this is a big base. This is the second base where we pause for about 4 weeks. Then this one is about 6 to 8 weeks long. This one a little bit shorter, about 4 to 5 weeks. And we keep pausing, reconfirming to the upside, pausing, reconfirming to the upside. And this is what a strong uptrend looks like, just gliding above that 10-week moving average, well above the rising 40-week moving average. This is a perfect stage 2 uptrend. And then you've got bases and opportunities to enter within the stage 2 uptrend. And we as traders want to be focused on, early stage 2. And Stan calls this stage 2A, where, maybe it's up the right-hand side of the first base, or coming out of the second base, or maybe even the second base. But later on, things just get a little bit, there's less potential go later on. And we want to be focused earlier on. That's when funds are much more aggressive in terms of accumulating shares, and we have more potential for that trend. So that's kind of a brief overview of bases and consolidations, and a great example of a model stock to study, ELF. All right. This is on a daily chart. This is Uber from way back when it was an uptrend. We see a base. This is just kind of a zoomed in view of one of these bases here. We have a pause, break below the moving averages. Then we reclaim it, move up the right-hand side very sharply, and have a nice pullback buy against the 21 EMA, as well as this key level, the base pivot. Nice confluence there, and just continue on with the trend. So this is what a kind of breakout from a base looks like. A lot of people are trying to buy here, and then it pauses and chops for 2 days. Really, you want to be either buying early on the gaps here, or be waiting for the pullbacks to the base pivot and moving average. And that's how you kind of manage risk better, and are buying not at a point where it's already expended a lot of energy and already had a powerful momentum move. Instead, you're waiting for a point where we can have a nice trend after your buy point. Here we begin a new base, pull back to the moving averages, reconfirm back up, and are looking for another base pivot breakout. All right, tight areas. So we've talked about inside days. We've talked about what they signify and how we look for tight areas on low volume. So I want you guys to kind of apply what we're talking about, because a key point for this webinar and also the book, because we have exercises in the book with every chapter, is we want you to apply this knowledge that we're sharing. It's no good to just kind of passively sit there and listen to us. We want you to apply this knowledge so you can so it can basically help you make your next trade and help you improve your performance. So a key thing to do that is to apply the knowledge that we're sharing. So looking at this chart of, again, Tesla, identify and kind of think to yourself, where are the tight areas on this chart? And a tight area is when, we can press in terms of volatility, and they present good entry points. There are signs of, winning characteristics, as we'll talk about. So let me know here and just kind of think to yourself. I'll show the answer in just a second. Where are the tight areas on this chart? Yeah, Arav says May is crazy tight for sure, right in this area. Late May, mid-June, early August. Very nice. Very nice. And by the way, tight areas can be even 1 or 2 days, because here you see expansion off lows, the higher low, and then these 2 days are very, very tight. And this is a subtle tight area that you want to be looking at. But yes, this is a longer tight area. This is a longer tight area. This is a longer tight area. And let's show the answer here. These are kind of the ones I highlighted. You've got one during this downtrend where it reconfirms the downside. This one, the first one, kind of off lows. This one as well. This one, these. There's a lot of tight areas of Tesla, which also made it was kind of a reason why it was a great trading stock. And the reason these tight areas are significant, again, we've talked about, it's a sign of subtle accumulation. We'll go into that further, but also it allows you to manage risk tightly, because if you're buying a breakout from this tight area, you can manage risk at the low of the day or the low of the previous day and manage risk really, really tightly. And what you're basically looking for is a breakout through the highs, which is what we call the range pivot. So this is kind of what the definition of a pivot is. A pivot point is a specific level / area in a chart pattern where we can expect the stock to become directional. Rai talked about how volatility is how we make profit as a trader, and a breakout through a pivot often signals the start of volatility. It's where energy can get released, and for me, it's often the high of a tight range. And a range, as we've talked about, is just a series of days where there's not much movement up or down, where the stock is basically compressing. And just like a spring, if we compress a spring, we're expecting it to expand either to the upside or downside. And here's an example of pivots. We've got one from this tight area. This is a zoomed in version of this area right here. We've got this range here. We have a nice inside day, breaks through the high of that inside day, then breaks out of this base, goes tight again, breaks out, goes tight again. This is what the best stocks do during their trends above the 21 EMA, is just breakout, tight, form another range, upside reversal off the 21 EMA, fall through to the upside, and expansion to the upside. This is where we want to catch a trade right here, and participate in this expansion. All right. It's much better when pivot breakouts coincide with base breakouts. Yeah, great point, Arav. So if we go back to this chart here, this is the base high right here. And let's actually go to deep view here, because I've got it prepped here. This is the base high, and this is a tight area kind of earlier on in the base, in this range here. But this tight area here happened right after the breakout, and then it goes dormant and quiet right at this base pivot. And it's always more significant when tight areas happen at key levels. And that's a golden nugget, and that's something you guys should write down, by the way. When tight areas happen right near key levels, it's showing you the kind of supply and demand characteristics at work, where people are selling into this breakout for sure, but the stock is holding up and tightening and holding near that level and being supported by institutions because they still believe in the stock. They're still accumulating shares and are looking for a much higher price down the road. So when a stock goes quiet and tight after breaking out, that's a key thing you want to look out for, because you want to be ready for the continued move higher after that expansion. And I actually entered the stock right on here on the reclaim of the base pivot. Is one of my best trades of 2020. And the reason it was so explosive, and I think just went like 20% in 40% in a matter of days, is because this tight area happened near the base pivot. So great point, Arav. Really good point. And what happened here? We had a tight area. We broke those lows all at once, breaking expectations. Anybody who set their stop here trying to anticipate the breakout got stopped out. We pull back to the 21 EMA, showed support there. This is where the institutions are buying right here. They're supporting the stock. We again hold the 21 EMA. We have an outside day. We get supported. This is the day I bought here. We break through this high as well. And then the next day we break through the high of this range. And anyone who's watching for this breakout is now jumping on, leading to this explosive move and great potential for a trade right here. So again, Tesla, a great stock to study. Yeah, go ahead.
Just to pause there for a second, like this type of pattern where we break multiple lows, we expect things to go down, but they don't, right? This right there is the same thing that happened on RKLB, right? Before this type of price movement. So if you start to look at this and you see this repeatedly, and you're seeing that, after a break of a level, many people are, either completely take it off their watch list or off their radar. They've decided that this stock is now completely has no chance of going up, right? But it's doing the opposite the next 3, 4 days. And that's why it's important to keep things on your radar, because this trend and whatever the thesis was can't be invalidated by just one bar. It can be invalidated if we continue to go lower and lower and lower, right? Now you get full confirmation that yes, this is broken. We came out of a tight area with low volume and it broke to the downside. But we broke to the downside and we got expectation breakers, and then a breakout that left, all those folks. And this is a lot of traders that, especially when you're beginning your stage one, stage two, you just make a crazy, you put a stamp on the stock saying, this is broken down, I'm not interested anymore. And oftentimes, leaders tend to do this before they double. And you have to come to that realization and that so that, whatever got this on your radar cannot be invalidated by one day. It has to be multiple days of, hey, I expect this to continue to go down. Yes, it's going down. Expect it to continue to go lower. It's still going lower. Okay, it's completely broken all my major moving averages, 50-day, 21-day, and now it can be off my radar, right? So I think that nuance is really important. And a lot of folks just say, hey, it broke down and I stopped tracking it, and then it went away without me, right? That went away without me is the fact that it didn't continue lower. It was just that one day at the end of the day. So
Yeah, and throughout this tight area, even though it breaks lower, it's still in an RS phase based
yeah,
on the relative strength line. And we have the RS new highs before price marked here as well. So this is another reason to really be watching Tesla is it was just showing such strong outperformance versus the market during this period before it doubled and tripled from this point. And these tight areas are so important, and it's such a nuance that top traders look for that I personally had been working for years to develop an indicator to really point out those tight areas. And in DeepView, we brought this indicator to life. This is called relative measured volatility. It basically goes to zero when we're in a tight area. You can see it happens here, and just helps point out the subtle tight areas. Even this bar right here, where Oliver Kell was accumulating the majority of his position, it's pointing out the tightness right there by going to zero. Expansion goes to 100. It gets tight again. Expansion, contraction. So 100 is expansion on RMV, and contraction, like this tight area right here, is when it goes close to zero. And this will help you so much, especially if you're newer, because not only can you use this under your charts, but you can also scan for this in DeepView. You can scan for stocks showing tight areas just like this. And then you see, oh, this is happening on low volume too. Oh, this is right near a base pivot here. This is a stock that should definitely be on my focus list. And if we go to RKLB as well, just to show another example, it's highlighting right when we get these inside days, right before the expansion. What happened right here? Tightness right before the expansion. And with faster movers, I can change the look back period to 5 days. By default, it's 15 days, and that gives you even more, aggressive tightness and expansions. But just RMV can help you a lot, especially if you're newer at identifying these tight areas. So you can be watching that stock and have it on your radar. Because my routine is to look for low RMV stocks every single day. That's what I'm looking for, and that's how you can catch these type of moves in promising stocks. So just want to mention that as well. And let's get back to the slides here. And here we go. All right. So I think that's a good spot to pause for the time being. So let's answer some questions. And by the way, today in the chat, we're going to be giving away a signed copy. So congratulations, you guys are entered. What you have to do, and we'll see who wins, is in the chat right now. This is to win a signed copy of the Trader's Handbook, which is coming out in May 27th. Drop the name of, or drop the stage number where we want to be involved as traders. We'll see who's the first person. The first person. Oh, all right. Well, that was quick. People are ready. I got to scroll. I got to scroll. All right. The first person. Oh my God. I can't even see. All right. All right. Stop, guys. We already picked the winner. We already picked the winner. All right. Ryan, did you see who won?
Let me just scroll up. There's way
Yeah.
too many.
All right.
Kai
Kai.
Zimmer.
All right. Awesome. Oh yeah. Kai. Awesome. Yeah. Congratulations, Kai. Shoot me a DM and we'll get you your signed copy once we have those available. So congratulations. And by the way, guys, if you didn't win that, which by the way, that was very quick. I'm very impressed by everybody. There'll be many other.
We need a harder question next time.
We need a harder question. Yeah. We'll think of one, but we'll have so many other chances to win a signed copy. We're also thinking of doing some in-person meetups to kind of meet you guys and give away more signed copies. So just be on the interest list. You can join right here. And we'll also be giving away signed copies specifically to people on the list. So if you haven't already joined, I think most of you are probably on here, but just scan this QR code. And again, that's how you also access bonus articles and get the first invites, priority invites to these presentations and webinars. And basically go ahead and join this list if you're interested in all that bonus material. All right, let's see if there's any key questions here. All right. And congratulations, Kai, guys.
By the way, we'll keep going because I see a few people drop off. This is not the end of the presentation.
Yeah, this is not the end. We still have quite a bit to cover. All right, I don't see too many questions actually, but by the way, RMV stands for relative measured volatility because it's identifying relatively tight areas compared to recent price action. And that's why it identifies those tight areas so well. All right, so let's keep going. So let's talk about breakouts. And by the way, guys, we're going to get so much deeper into setups and edges in the next webinar, the webinar for this. This is just a high level technical analysis 101 for you folks. So breakouts are basically a breakthrough, a key level, and often, similar levels during a consolidation. So this level is the high of the base. This level is actually pretty close, and that adds explosiveness to this. Look at where it reversed down here. And again, this is a downside reversal right at that key level where we reject down from. We're looking for a breakthrough on volume of the key level of the base, which is the significant resistance point. And we're looking for it to happen on volume after the stock begins respecting moving averages and shapes up constructively, and off to the races it goes. This is Zoom way back after its IPO. This is when the overall market was just topping and entering a correction. It was showing significant relative strength in this area. And what happens? Zoom breaks out strongly and goes tight. Look at volume here as well. And this is exactly what we're looking for in terms of a breakout and what happens after a breakout. We want to see the stock break out, respect moving averages, go tight, expand back up, go tight, expand back up, higher highs and higher lows above the moving averages. And exactly what Zoom did here. And if you look at this chart, I wanted to point out this bar as well, because this is kind of a hidden early entry or just a way to get Zoom on your radar earlier before this breakout. Because what do we have right here? We have a gap down on big volume on earnings. What's the expectation after a big gap down with a negative close? Probably that we continue to the downside and undercut this low, right? What happens? Zoom gets supported. It pulls back to that level. It gets supported again. It forms this range right near the moving averages. Very low volume. Look at the volume right here. And again, you'll see this over and over. These are blueprints that all great winning stocks share. Tight range near the moving averages on very low volume. And then we get the outside day. This is the buy point here. This is the buy point. This is the early buy point. And this gives you a profit so you can sell this into strength, sell a little piece, or just, hold on for the ride as it respects the moving averages before the true base breakout. And if you miss this, don't worry about it. It's just more added evidence that a breakout will work and that Zoom has high potential. So early buy points, if you miss them, just kind of add, add evidence, as I mentioned, increase the odds that a breakout will lead to a promising trend. So that's kind of how to use this as well, even if you didn't enter. All right, so here's a quick checklist for you guys. I know everybody loves checklists. Look for tight price action in the base before breakouts. Look for higher lows. You can see this is the low, higher low again. A clear pivot point, ideally where multiple highs line up. That adds fuel to the fire. We're looking for a clear pivot point like that. Then look for explosive volume, and that's what you're looking for in a breakout. And then we want to see follow through, tight areas, reconfirmation up. And obviously, we all know that Zoom went from 100 to, I think, about 550 after this move. So this would have been catching it at about 80. And there are other breakouts along the way, but this is just kind of the early one. And this also lines up to where the 150-day was and the 200-day moving average was. So there's a lot of confluence right in this area that it signified a nice turning point. And one other golden nugget that I want to share with you guys today, and this isn't something that's talked about too much, and this is mentioned in the book, is when you're watching a bigger base and it's setting up higher highs and higher lows, look for respect for the 50 SMA before the breakout. Because actually NVIDIA did this during its nice base breakout in early 2023. As a stock oscillates above and below during its base, it probably won't respect the 50 SMA too much. When it starts doing so near the highs of the base, that's a point to really be focused on the stock and watch for the breakout potential, because that tells you that there's now an institutional bid at the 50 SMA, the 10-week moving average, and the stock is more likely to have a successful breakout. And let's actually go to NVIDIA here and show exactly what I mean. There we go. So this is the bigger base that we had in 2023. This line is the 50 SMA. And you can see it's oscillating above and below it. There's no respect for it. And I'm going to hide every other line just so it's not confusing for you guys. This is the 50 SMA, this moving average. Look at during this base, there's no respect at all. Then what happens? It forms a higher low on the 50 SMA. Here it pulls back to the 50 SMA area, doesn't even reach it, respects that area immensely. And then there's the breakout a few days later through that base pivot. So this is a golden nugget to look out for in terms of bigger bases, is watch for stocks that start respecting the 50 SMA, and then watch for the breakout on big volume. And we all know what NVIDIA did after here. It doubled in a short amount of time. So this is a key thing to look out for, respect for the 50 SMA after it's been in a bigger base there. All right. Yeah, hopefully this is helpful to you guys. We're going through a lot of extra stuff that I didn't plan on, but it's hopefully helpful to you all, and you guys are enjoying this. All right. Next up, pullback. After the breakout, the additional buy point area is a pullback to a key moving average, a key level, ideally a confluence of levels as well. This is ALAB, one of my biggest winners from last year. Started noticing the increase in average volume, which is hint at winning characteristics we'll talk about in just a minute. But then we've got pullbacks on low volume to the 21 EMA. Then we have a pullback to the 21 EMA, gap up, pullbacks to the 10 EMA, pullbacks to the 10 EMA, nice tight range here, reconfirmation to the upside. So these pullbacks are key and great spots to add to a position, or if you're early enough in a trend, even start a new position because you manage risk really clearly. If it violates the 10 EMA after you enter, you're out with a small loss, no harm done. So here's a checklist to look for. And by the way, we're going to get a lot deeper into this in the edges and setups and entry tactics, all of this. This is just a little preview for you guys. We're looking for a drift back into the moving average, not just a one-day gap down negative close right at the moving average. That's probably much more likely to break through and start a correction. We're looking for a drift back, a nice orderly trend back into the moving average. We're looking for low volume on the pullback. And then we're looking for that resumed upward move. And that's where we enter. And we actually have a positive expectation breaker right here as well at the moving average. So let me zoom in here. All right, and hopefully this is helpful. Sorry for jumping around a little bit. We have a nice orderly trend on low volume. Negative close. What's the expectation after a close like this? Right near a key level. Probably a gap down and fall through to the downside, maybe a test of the 50 SMA. Instead, we gap up and break out. We break out through this high. This would have been a buy right here on the 21 EMA pullback and range breakout. And then this starts that resumed trend. Respect for the 10 EMA throughout. Pull back to the 21 EMA, orderly pullback right before earnings, gap up, and then we start respecting the 10 EMA during here and form a nice tight range inside day on the 10 EMA. What happens after inside days? We prime overall setups and we break out the next day and just keep trending. So there we go. And sorry for zooming in and out for you guys. Hopefully that's not too distracting, as helpful to you guys. And on the resumed upward move, we're looking for a pickup in volume. Doesn't have to be huge. Doesn't have to be like breakout volume, but just a little increase in volume compared to the pullback. Rye, actually, anything to add on both pullbacks or breakouts? Something you like to look for during either of the setups?
No, I think price tightly pulling back in where closes even on the drift back are closer to each other than high volatility bars with high ADR to them. You want low ADR during pullbacks. Second is volume drifting lower is fine as long as you don't get high volume accompanied by smaller bars. That also can be concerning at times because that can lead to greater volatility in the next few days. So ideally, you want volume to confirm that price action. That's the most ideal way a setup can form for you to have the highest position size and highest conviction and things of that nature. So, I think during a pullback, don't forget the prior uptrend as well. You need context that it's holding the rising 10-day, it's holding the rising 21-day moving average. Those act as technical factors, but also act as psychological factors for you to continue to hold if you're already long the stock during a pullback, right? Uh, I think during pullbacks, traders can tend to sell early and often instead of waiting and being patient and having a set of rules where, hey, I know that this stock is showing a characteristic, which I think we'll get into the next slide, of a winner. And stocks that exhibit these characteristics tend to double and triple or go in massive uptrends. Having that at the back of your head while something is pulling back is also, helpful, and it allows you to interpret the price action the right way rather than panicking and thinking, okay, I've given, I was up 10%, I've given 4.5% already. I don't know what's going to happen. You sell it the next day, it keeps going, and then you're in a bad situation where you're buying where you're not supposed to, you're selling where you're not supposed to, and you create a whole mess for yourself. And all of that just comes, repetition, different situations. Every trade is a situation that you have to handle. And when you handle it well, you feel great. When you don't, you learn from it, keep going forward. So,
And I think, Rye, this is something you actually taught me that was really helpful for managing a position. And we've got a whole webinar on position management, guys, by the way, coming up. But when managing a position that you've got a really good profit in, and A-Lab I had, it was one of my best trades of last year. It made kind of my fall. I had a really big profit on a pretty sizable position in this name. And if you look at the fluctuations, intraday, it could be up 8%, then up 2%, even down. But it was always respecting the moving averages. And you had this, you said this to me a few years ago, and it really helped me a lot, is think of your profit in terms of where the moving average is, not necessarily where the price action is. So instead of thinking about, this the price is up here, I've got this amazing profit. I bought down here in this area. Um, think about the moving average, which kind of smooths out the fluctuations and smooths out the equity curve. And as long as it's respecting above the moving average, it's healthy. Just keep an eye on it, keep managing it, and let the outliers work, right? If you sell too early, before a stock breaks the moving average, you're not letting the asymmetry of a trend work for you. And that's something, I've been working on specifically the past 2 years. And that switch in thinking versus my profit is all the way up here. This is what I've got, this gain, versus just kind of watching the moving average instead and watching where my cost is versus the moving average. That helped immensely for me immensely holding winners longer. So right, thank you for that, and I think that can be helpful
and
to everyone watching.
Alexi in the chat really said, watching your profits melt down during a pullback is never easy. And it is never easy. And that's why context is also important, right? You're never going to catch the bottom 5% or the top 5% where you sell perfectly and you buy perfectly. And that's just the nature of how trading goes, right? Once you come to that realization, it becomes a little bit easier, but still not easy for sure, right? Who wouldn't want to sell A-Lab perfectly at, 141 and 56 cents and buy it exactly at $36.08? It's just that's not reality of it. And what Richard said about moving averages, when my average price is yeah, when the 21 day moves above my average price, then I'm only looking at the 21 day at that point. And it becomes it becomes much easier for me to just look at a stock and continue to hold it. Whereas if I were to look at daily price action, it becomes harder and harder. If I know that it has a winning characteristic, if I know that it's going in an uptrend, I know it's part of a theme, I know that the market's about to back it because the market is shifting into an uptrend, multiple factors are aligning. I need to let it work rather than worry about, hey, why did this shake out today? Why did it reverse off the lows today? And over a series of trades, things will average out and you have a much easier system that you can implement, right? A more predictable sell rule is, if it breaks two closes below the 21 day, I will be out. It's a very simple rule. It's a very predictable way to go about it, and it takes my opinion or my um, you know, anything else that can influence my decision out of it. And it's a very simple decision to make as well, right? And as we get into these other webinars in the future, we'll really emphasize how you can simply, make something try to take randomness out of everything that you're doing, introduce some system to it, and follow that system because over a series of 5, 10, 50, 500 trades, it will work out and your equity curve will curve to the upside and you will make progress in the markets. So,
Perfect. And we'll talk about why this got on my radar early on here. I actually did a lot of tweets about this as well, and it's one of the winning characteristics we're about to cover. So let's get into this. And actually, it's the first one here, so a little surprise there. So these are winning characteristics that make us focus on a stock, and they are characteristics that if you study previous model book stocks, study previous market leaders, they're going to show up again and again because they're just signs of institutional activity, accumulation, and bid. So first things first, we've got an increase in average volume. I'll point that out in a lab in just a minute. Then huge volume spikes. So in addition to average volume, Ryan, I know you created the HV Edge, and we'll talk about that in the next webinar. But that's a big part of that here, as well as just big volume spikes on the weekly. Tight areas on low volume, we've already talked about quite a bit today. So you've shown how that gets put into place. It's just a sign of accumulation. Respect for moving averages during trends. We'll talk about which moving averages we like to use and why. Powerful prior moves. So a stock that has doubled is more likely to do so again because it's under accumulation. Strong gap ups, and we'll talk about which ones we like to focus on, and then relative strength as well. These are all winning characteristics that you should look out for as you're analyzing charts. So, from today's webinar, we've talked about going from a single bar to analyzing short-term patterns, larger context, all the way now to these winning characteristics. So hopefully this has been helpful to you guys. So increase in average volume. This basically identifies an increase in liquidity. Watch for a price surge in addition to an increase in average volume. And to identify this, how do you do that? You look for the moving average line to be increasing. It's that simple as well. This is Zoom. This is the area we're talking about. This is the breakout we talked about on a daily chart. And then this is what happened, of course, afterwards. And in addition to the increase in average volume, look at the respect for the 10-week moving average during this trend. It doesn't want to close below it. But yeah, this increase in average volume is what we're focusing on. And the reason for this is that funds can't hide their activity and their accumulation. They're trading hundreds of thousands of shares, millions of shares. They have to accumulate over days, weeks, and months. They can't just market order stuff. And that volume is going to show up at key points during a trend, and overall liquidity is going to increase. And then when liquidity increases, even bigger funds can get involved when they couldn't before. So this is kind of a great characteristic to look for. If we go back to ALAB, during this market bottom, look at the moving average of volume. It's subtle, but it's there. And then look at these spikes, spikes. And then average volume is increasing overall right here. And what's price doing? We were in a downtrend since this IPO bust phase, which we'll get into during that zone. And then we have an upside reversal, fall through to the upside. We break lower, but look at this bar, extremely negative, right? We'd expect this to really just fall apart and continue the downtrend. Instead, we form a range where none of these bars break lower, right? And this is just kind of clear bottoming type action where we're fighting the downtrend. Momentum is slowing, moving averages are catching up, and we form a key resistance line here. We actually try to break out, get rejected, and fall all the way back to these lows. But again, we are respected and move higher. And all the while, liquidity is increasing. We're seeing spikes in volume and just subtle signs that we're pointing out to you guys of accumulation. And then that's where you use your entry tactics to look for a pullback to a moving average, the breakout. You might get stopped out here, but you always want to try it again if you can. Gap ups, those are other winning characteristics we'll talk about in just a second. But this subtle average volume, and I tweeted about this in real time, is what I was looking at to get a lab on my focus list and prepare for one of my best trades of last year. So that's a lab there. So getting into
Just
the next, yeah, go
just
ahead.
a thing about increasing average volume. A lot of industries that are new, like uh, could be, a certain segment of biotech, a certain, the cannabis theme that we had recently, or the younger AI companies that came up. Um, a lot of that is represented with increased interest from market participants. In the newer market, it's also related to, retail traders influencing price action, and that's a reality today that we have to deal with. But all it represents is there might be new, every new theme that has emerged in the markets over the past X amount of years has always had, is always accompanied by an increased daily average volume, slowly based on all the market participants seeing the potential in them. That could be social media companies that came out of China back in 2018, right? That can be the fish oil trend in the biotech space where a lot of those companies went up at once. That could be the software trend that started back in 2010 from OKTA to a lot of these SaaS companies that were unprofitable, but were driven on revenues. And that became a new thing where if you had revenue and no positive earnings per share, that was represented in increased daily average volume as well. So trends in the market and themes in the market that are newer technologies, newer themes, newer anything, newer merchandise, and anything that can potentially disrupt something, all of that representation comes as increased daily average volume on the charts. So it's a very important characteristic to keep an eye on. You'll see a lot of biotechs or a lot of semis at once or a lot of AI related stocks see see an increase at once, and you could pinpoint that theme right away as well. So
For sure. Perfect. So on to the next winning characteristic. We've got huge volume spikes. We're looking at a weekly chart here with PLTR, but Rai will show you in the next webinar how to spot the HV Edge, the highest volume in 1 year since the IPO ever on a daily chart, and how he uses that specifically to find big winners. But here we're looking at it on a weekly chart. And again, it's that same idea of this one. This kind of builds off the same idea. Funds can't hide their activity, and huge spikes in volume is a clear sign of big players becoming involved. And we're not talking about a $1 stock here, which has a 1 day spike of 20 million shares or whatever. We're talking about quality merchandise and significant increases in volume and big spikes. This is PLTR as it was bottoming on the weekly chart. Again, look at this bar and think about what we talked about with regards to closing ranges and shakeouts today. This is bottoming type action. We pull back to the moving averages, tighten quite a bit. And then we have actually an earnings gap, which is this bar right here. And look at the weekly volume, the 5, 6 weeks after it. And you see the increase in average volume as well. Huge volume coming in. And this was the start of the now 1000% move in PLTR. And you could have spotted it very early on using the weekly chart, looking for big spikes in volume, looking for gap ups, which is what we'll talk about in just a second. So PLTR, a great example of this, and big weekly volume bars, basically double and triple what it had been doing during this entire period. And we even had an early one here to get it on your radar too. So maybe you could do a scan every weekend that looks for volume twice the weekly average volume, and that would get your PLTR on your radar earlier. You would identify, maybe it's in a stage one, late stage one, potentially entering a stage two uptrend, and be ready for this earnings gap here. Tight areas on low volume, not too much more to say than we've already said, but it basically represents an equilibrium price, lack of sellers, subtle accumulation. There are potential entry areas that we talked about with the range breakouts. We'll discuss more of that in the setups and entry tactics webinar. And you want to look for them at the lows of bases or up the right hand side. And the lows of bases, maybe it's not actionable for your setup, for your style. Maybe you like to prefer buying closer to base highs, but it's still a sign of accumulation by institutions. There's many examples of tight areas at the lows of bases before huge model book winning stocks. So tight areas on low volume, definitely a winning characteristic to pay attention to. Next, we've got respect for moving averages. It just basically is a sign of consistent demand and accumulation by big players that will encourage the continuation of the trend. Here we've got Roku back in 2020, showed clear respect for the 10-week moving average during the uptrend, and then when it topped, it showed clear respect for the 10-week moving average during a downtrend. So instead of consistent demand here, it was consistent selling here. And here's kind of a good rule of thumb. I saw somebody ask, what moving averages to use. I like to look for 10 EMAs during power moves, basically right after gap ups or right after breakouts, the strong breakouts. The really powerful ones. Look for respect for the 10 EMA after those. Then during momentum moves, after the stock maybe calms down a little bit, but is still trending nicely, look for the 21 EMA. And thanks Rye for editing on the fly here. And 21 EMA during momentum moves. It's amazing how stocks can rise 200, 300% during strong uptrends during bull markets without breaking below the 21 EMA or the 21 simple. They're going to show basically the exact same level. I'm predicting the question: why do you use the 21 EMA versus the 20 EMA versus the 21 simple? Put them all on the chart, and they're going to show basically the exact same level. It doesn't matter; it's just a reference point that's around the same time frame. Some people like to use the 80 EMA. Find what works for you. Study history, study previous charts, because it's more about price action, how it's building, and also that relative area. 21 EMA respect doesn't mean it can't undercut it a little bit. You just kind of want to watch for general respect, and then on a weekly chart, look for 10-week moving average respect during duration moves, like we saw with Roku, where it increased all the way, several 100% during this move, and then declined almost 100% during this stage 4 downtrend. So again, stage 2 uptrend, stage 4 downtrend. Respect for moving averages during both those stages.
And
Right?
it's really
Yeah.
important to, yeah, the key here is these are not absolute values, right? Something's not going to touch that low and just get scared off of it, and that's your absolute low. So stocks, when we say respect a moving average, they can undercut and close below, close above it. That's still considered respect, right? A stock can come in and test the 21 day. Uh, maybe close one day below it, and next day it starts respecting it again, right? So respect for moving averages is more of a zone instead of an absolute level,
Yep.
and that's what most traders kind of can't grasp really, really quickly, right? They want something very certain. They want, it will come in and stop at this to the penny, and it will rise up. There's too many unknowns, too many market participants, and too many things at play for us to know absolutes in the market. So things are zones, stop levels, are areas instead of like absolute, points to the penny, as well. The other thing with moving averages is some stocks will never respect a moving average that you use every single day. So if I am trading a PLTR, had high respect for the 10-day and the 21-day in its uptrend, right? It's shown that in prior uptrends as well. Now, if I, let's say, were to use the 13 EMA and the 26-week moving average, it wouldn't have respected those moving averages, right? But a stock can still be an uptrend. Maybe it's just respecting some other moving averages. But as you trade in the markets, you'll find your style. You'll see that many leaders in the market respect the 21-day area quite often. Many leaders in the market respect the 50 or the 65 that Ross uses, the 65 EMA based on a study that was done, right? So traders find different ways, and it's all about your style, right? If a trader A says 21 EMA, trader B says 21 SMA, when I looked at my trades, SMA worked better for me because it allowed me to hold a little bit longer, whereas EMA would skew to the recent price action. And based on my trades, if I use, the SMA versus the EMA, I actually gained 3% in terms of my average P&L over a span of, 50, 60 trades over the past year. So then I adjusted to the SMA. So some of the decisions have to be very personal. They're not absolutes like trader A told me to do this, so I have to do this. You have to take what they say, apply it, see if it fits your time frame, lifestyle, how you see stocks, and then use and come up with the best set of moving averages that cater to your system, the best, really. So I see a lot of questions in the chat, a lot of questions in the Q&A of why are we using 21? Why are we using 10? Why are we using this or that? Why not another one? It's just most leaders in the market tend to respect the 21-day area. Most leaders in the market tend to have high respect for the 50, and the market as a whole tends to have high respect for the 200-day. These these are based on observations of how the market has been trading in the past. Can it change in the future? Yes, it can. When it does, we will adjust, right? So these 10, 21, 50, 65, and the 200 have what we found to be most consistent among market leaders as we've traded, including Ross, who's been in the markets for 30 plus years as well. So it's very important to not get hung up, on absolute numbers, areas, which numbers. Just find, use it. It will work better for you. If it doesn't, you switch to another one. You'll figure it out, basically.
And it's part of the character of the stock, which moving average it respects, and that's part of kind of learning each stock. And by the way, I want to zoom in. Sorry for all these asides, but there's just such great examples of closing range here. This bar, look at the closing range. The close is right here, by the way. It's right by the 10-week moving average. We tried to push up, and this is a weekly chart. So again, closing ranges work on weekly charts, daily charts, intraday charts. The concept applies on all time frames. We have a close well off highs. We have a fade. This starts the really significant part of the correction. So if you notice this, you could be more on guard. And if you own Roku, you'd be exiting. Or if you're shorting Roku, this would be a great place to go short as it broke these weekly lows. Then on the base bottom, what does this bar tell you? Let me know in the chat here and in the comments on YouTube if you're watching here. What does this bar tell you right here? What does the closing range look like? That's probably about a 85% closing range after the low being all the way down here. Buyers one, reversal, demand. Nice. Excellent, guys. You guys are getting it. And then we see reconfirmation here. Then even here, this is another example of the short-term pattern we talked about. We see demand off lows into the moving averages, forming another base. Then what do we have before the breakout? An upside reversal bar off the moving averages. Again, guys, this applies on all time frames, whether it's a daily chart or weekly chart. What's down here? A tight range where the closes are all close together. We see expansion up, then the upside reversal, and then we break out. What happens here? We have a very negative week that undercuts these weekly lows. The expectation is we're going to fall apart below the 10-week moving average. What happens the next week? Big, powerful bar, then inside bar, then the reconfirmation of the trend. What happens here? Again, big, powerful bar off the 10-week moving average. So these concepts apply in all time frames and can really help you read the tea leaves of the market just that much better. What happens at the bottom of this base? Big closing range off lows, then a range that forms, then a strong, powerful bar breaking through these highs. What happens at this base breakout? This is kind of a negative example. We have kind of a similar situation to what we saw right here, where we have a move up, negative bar, positive bar, but then there's no follow through. Instead, we get a downside reversal. That gives you a warning sign even before it breaks the 10-week moving average and really starts this downtrend. And throughout here, there's many examples of fades at the moving average, reconfirmation down. So these closing range techniques work on all time frames. All right, sorry for that aside. Next up, powerful prior moves. Stocks that double like to do it again. Ability to trend cleanly is what we're looking for. A strong trend above the moving averages. Trend, base, trend. That's kind of the textbook of the strongest stocks. And Rye, I think another thing that you taught me, just a great framework to think about, is from this buy point that I'm looking at right now, does the stock have the potential to double? And a strong trend before that's clean above the moving averages, for me, is a really good indication based on studying previous market leaders. I don't know if you have anything to add there.
Yeah, no, I to reduce the frequency of your decision making in the markets, you have to gauge yourself into what you feel are high potential stocks that can really make significant moves for you to actually, spend some time. Like you have to, there's 11, 12,000 stocks in the market. That number is increasing every single day with derivatives of 2x, 3x of Apple and things of that nature. How do you find the best ones? And how do you, clearly focus, on them is to really say, okay, I've seen this pattern before. I've seen these winning characteristics that we're covering right now before, and these stocks are the ones that have doubled and tripled. Then why not take that 11,000 universe of stocks that exist and boil it down to maybe a few, 10, 15, or 20 stocks? That will give you, you're concentrating, your focus, that these stocks have the potential to do something special, And you're not looking at, hundreds of stocks at the same time, which increases your probability, right? Of catching a winner, or seeing a base clearly, or tracking. The best stocks that I track over multiple weeks as to what their action is. I get more confident that, hey, a down day in the market, this stock didn't really do much to the downside. It stayed steady and sideways. So, taking that, focusing on a few winning characteristics, narrowing your universe will allow you to focus on the most powerful moves and ignore all the garbage, things that, like the Boeings of the world right now that are not in a trend but choppy, but yet a lot of people tend to trade them every single day. They're not going to double, triple, and then some really, really quickly. Whereas this framework of focusing on, winning characteristics will allow you to do that, again and again every year in the markets.
Yeah, by the way, on the subject of derivatives, I personally love the three and a quarter version of Nvidia. That's just my bread and butter to trade. But I'm just kidding, guys, by the way. But anyway, I don't know why we need
Easy.
3x and 5x of all these. But anyway, getting back to the subject. Gap ups. This is actually a daily version of the PLTR chart that we saw right here. So this is the weekly chart of the gap up. Here is the daily chart where we had a powerful gap up on the was it HVE, right? I think it was
HV1.
HV1.
Highest volume in a year. Yeah.
Yeah. And this was also in based on positive earnings where they were really turning the tide. A lot of the first gap ups in recent IPOs where they become profitable or, express profitability is right around the corner. That's when to really get interested in a stock like PLTR. We had a strong gap up, tightened, and let me zoom in here just because the price action is awesome. Gap up on Catalyst, earnings surprise. In deep view, we show the earnings surprise as you hover over quarters, so you can really see the catalyst for a move. We see this strong breakout on HV1, moves up, pulls back, forms a range right at this key level, this key weekly level. What happens right before the momentum move up? That looks like an inside day or an inside day in spirit. I think it might pierce the high a little bit, but it's the same thinking behind an inside day. Again, we're just looking for contraction, and that's what we see right here. And then we see expansion up on a pickup in volume, and then obviously we know what happened next with PLTR, 1,000% move over the next a year, year and a half, 2 years. So this catalyst and gap, that's a key winning characteristic to look for, and pay attention to when it happens at the right time in the right stock from a big base. And we like to focus on the first one to really two and a half gaps in a trend. And gaps basically represent that the street got caught off guard based on the catalyst for the gap, whether that's an earnings surprise, whether that's a new product, a new CEO, something game changing is happening with the company that is changing how institutions are valuing that stock. And again, we've talked about this. Institutions can't just market order stuff. When they change their opinion based on their spreadsheets and valuation of the prospects of a company 5 years down the line, which is how they make their decisions, they have to accumulate over weeks and months. And that creates momentum trends that we can take advantage of as retail traders. So that's why gaps are present such an opportunity. They're scary to buy, but there's ways to manage risk. And we talk about that in the book. We talk about that. We'll talk about that in just a few sessions as well. So watch for gaps at a well-formed basis with very strong catalysts, like the first signs of profitability, like we saw with PLTR. Ryan, I know this is kind of your bread and butter. Anything you want to add on Gabos now? I know we'll get a lot
No,
deeper
I
into
mean,
it. Yeah,
we're doing a master class with Pradeep
yeah,
Bonde, what, next week?
yeah.
I think he's the master of the catalyst side and earning surprise, how to gauge them, what's a good one versus a bad one. Um, for me, it's very simple. If it's the highest volume in a year, if it's the highest volume since IPO or the highest volume ever, I'm paying attention. Those are the stocks that I found that, in the next 6 to 8 months will double. The catalyst side of it is usually fueled by earnings, sales, surprises, but also things like buybacks, announcing enormous buybacks. So PLTR announced, $1 billion. They're going to buy back their stock, take that, off the market. That helps fuel price action as well, along with, it had good earnings, good sales or increasing sales, things of that nature. So, but if we focus on today and what we're speaking about from a technical perspective, if you see a big bar, we will get into it in the Edges webinar. But if it's the highest volume in a year since IPO or ever, you have to pay attention to it because those are consistently the stocks that tend to double and triple.
Yeah, and like ASTS is an example from last year that was driven by partnership news. So depending on the stock and the situation, where they are in their life cycle, different catalysts can trigger the moves, and that's what Pradeep is really going to get into in next week. And I'm really looking forward to learning from him. And I see some questions in the chat. What did I mean about the first 1 to 3 gaps? What I mean is basically if we look at the trend, this is the first gap up in the stage 2 uptrend. If we have another gap up, that would be the second gap. If we have another gap up on earnings, that would be the third gap. ELF, if you look at that chart on a daily, it had like
Serial, yeah.
6 gaps. It's a serial gapper.
Yeah.
The earlier ones just have higher potential because funds are more aggressive earlier on in a trend. Um, and it just leads to higher probabilities. So we like to focus on earlier ones. Doesn't mean the
And
later ones can't work, but it's just lower probabilities. Go ahead,
it's
Ryan.
more like the late stage versus the early stage
Right.
on technical analysis. When you look at a weekly chart, it's hard to buy a stock that's gapped up 4 quarters in a row. And now if you look at
Yep.
APPS right
That's what I was
now,
gonna think. Yeah.
that's one too many, and the market cycle is against it, and things are going to reverse. There's no way a stock can gap up, just keep going, going, going. The market has a big role to play in that. There's a market environment for gap ups where they work, and we'll get into that in the market cycle webinar quite a bit. And there's an environment where gap ups will not work, even if they have the best catalyst, earnings, sales, surprise, buyback, you name it, the best news ever, right? So it's always relative to market trend and risk appetite and funds seeing that, hey, this company has a lot of potential. ANF was the same one, by the way. Same
Yeah.
look.
Yeah, exactly. I mean, ELF had like the earliest gap down here. This move started with a gap. That's why it's so significant to look at it. And this is so early that it's funny. But you had a gap here, you had a gap here, gap here, gap here, gap here. And it's funny. Each of them respected the high volume close, which we'll get into later on. And then I saw somebody ask this in the chat: Are gap downs the same way? Yeah, to the negative side, it's the same way. I think an MSFT recently had a gap down, which started this downtrend. TTD had been trending for quite some time, then this had this gap down, and look at the trend since. So gaps are so important in the market, especially when they're related to a catalyst, and it's a nuance that you want to look for. I know Oliver Kell, obviously he killed Tesla back during a strong uptrend. He watched this subtle gap down at the top here and recognized that Tesla wasn't really meant to be looked at anymore because it wasn't able to fill this gap way back here. And obviously Tesla was kind of dead money for the next 2 years or so. So subtle gaps, if they're filled or not filled, strong gaps on earnings, there's something to pay attention to because they give insight into the supply and demand imbalances in the market, and that's what's really key here. All right, let's go. Sorry for keep jumping to DVU and back and forth. Here we go. Where's present? There we go. All right. Hopefully the extra examples are helpful to you guys. All right, relative strength. This is very clear cut. Here's Zoom again. We're looking for outperformance versus this market. This could be based on the relative strength line being an RS phase, being an uptrend like we see here with Zoom. It could be based on holding moving averages when the market breaks below them. There's many different ways to define relative strength. It could be, holding a better off highs versus the market, but basically we're looking for outperformance and resisting market declines, especially during corrections. And an easy way to do that is to plot the relative strength line on deep view and just see if we're above, and in an uptrend here. Ryan, anything you want to add on RS relative strength? I think probably most people here are familiar with the concept.
Yeah. Yeah, I mean, it's one of the things you want to hold stocks that outperform the markets. That's, clear cut unless you're a value investor, things of that nature. Um, and you want to be in stocks that can, really rise up and go if the market's moving 2%, they're moving, 4.5, 5%, right?
Hmm.
So we'll get into ADR, ATR, how they play a role, and most importantly, relative strength phase and what that means in later webinars. But it's one of the biggest winning characteristics is you want to be in stocks that outperform the markets, the relative strength line and the relative strength phase put you in those stocks. And some recent examples, if you pull up Tesla, for example, it got out of a relative strength phase, on uh, basically January 22, right? And that was when price was above $400. Now it's trading at 220. So if you want to continue to own stocks that are not outperforming the markets, again, it's not outperforming the markets. There's no reason to own it at the end of the day, right? So you'll see that the 21 day usually aligns with a relative strength phase quite well most of the time. And it's a really simple rule where you can just avoid large losses, right? If a stock is not outperforming markets, I don't see a clear reason for me to own it, especially as a growth stock trader, right? I'm in it for momentum. I'm in it for momentum to the upside. If there's no momentum to the
It's
upside,
one vocal.
there's no outperformance to the upside. There's no reason for me to hold it. So
Yep, perfect. All right. There we go. All right. Next up, and this is kind of what we talked about a little bit, reading the character of the stock. And it can be based on ATR, ADR, float volatility, trendiness. I just made up that word. But really just looking at a chart, you can kind of see how a stock trades. You know, does it like to follow through? Does it, close off highs quite a bit? Does it fade? Does it follow through on moves? There's certain characters and stocks that are just like really difficult to trade. And Oxy is the example here, and it's a good example because it's related to an underlying commodity, right? So that's going to add kind of jumps and fits and starts and all that. Baba is another one that's related to, it's an ADR, so it's going to be choppier and all that. It's going to have more gaps. Bitcoin related names are going to have, more fits and starts, all of them based on, the how funds value a company is going to create, different characters in the stock. And what we're looking for more compared to what we're talking about here, which is a choppy trender, is a clean trender, like NVIDIA when there's accumulation, respect for moving averages, clean trends, follow through from bases. When it gets going, it just keeps going. Versus Oxy is just a lot, lot moves up and down, false starts, false breakouts, all this. We're looking for clean trenders. We're not looking for choppy trenders. That's kind of the meat of what we want to get across here. There's some stocks that go up 100%, 200%, but it's very hard to find a spot that gets follow through, right? Right. Anything to add on kind of differentiating between, stocks that you like to trade versus stocks that are just, a little bit more
yeah,
difficult?
I mean, over time, you'll realize things in the 100 million to 200 million float will be your biggest performers. That's important. As you stomach more, build a stomach for more volatility, you naturally trend towards higher volatile stocks, and then that's when you place ADR greater than 3% at
Yep.
the daily range because you can kind of see how, you know how to handle that now. Um, Liquidity in terms of uh absolute putting greater than 20 million in that average volume that can allow you to stay within a really highly liquid domain. That's what Oliver does quite a bit in his trading. He always trades the same 8 to 10 stocks, and he seldom, adds a new one to it when he feels like it has potential to run. And he just trades the highly most liquid stocks, and he doesn't care about anything else, right? So, each of these tie directly into why a stock can double and triple, and it's equally as important to understand these mechanisms, right? A stock with a 5 billion float or outstanding shares is naturally going to move a little bit slower, right? In the markets because there's so much supply, it's going to take enormous volume to move something. Pull up like SIRI on the charts. That's something that, Buffett's accumulating because it has a good dividend, but that thing's not going to double and triple because it likely has a ginormous float
What's the
associated
stock?
with SIRI, Serious
That's all right.
Holdings.
I
Yeah.
gotcha.
They
Yep.
might be doing pullback buybacks recently, but that again is a higher float stock. It will be very slow, sideways, choppy, dividend based type of situation. So yeah. So these will tie directly into that. They're equally as important after you identify a winning characteristic. So
Yeah. And one thing to maybe add here is, like you said, right, where the stock is in its life cycle. I saw somebody mention LMT, early on. LMT is a stock that's been here out for decades. It's not going to have quite the same potential as a recent IPO that most funds still don't own. and if the theme catches fire, can grow tremendously fast. So where the stock is in its life cycle, is it a recent IPO? Is it a more mature growth stock that still has a lot of potential, or is it a stock that's been out for decades that is like McDonald's, where you look at the chart and you're like, wow, that was an amazing move, and then you measure the move and it's like a 10% move over 3 months. It's like, you want beta as a trader. You want to get rewarded for catching a trend, and higher ADR stocks just lead more to that. So that's kind of one other thing to think about as you're talking about it. All right, we've got another surprise giveaway for you guys. So thank you guys all for we've got hundreds and hundreds of you still here. So this is a little bit of a surprise and a reward for everybody who's stuck around thus far. If you scan and share the tweet that you basically create after scanning this, you've got a chance to win a TraderLion Masterclass. I'll be announcing the winner later today. And as a special bonus, everybody who tweets it out, I'll DM them a $50 TraderLion gift card coupon code. So you've got a chance to win a masterclass, and you will definitely receive $50 in a TraderLion gift card. So I'll pause here, answer a few questions, but definitely join this. I think it's a great chance. We've got so many excellent masterclasses, Oliver Kell, Stan Weinstein, that you can win here. So definitely go ahead and do that if you found this valuable as well. We definitely appreciate it. And I saw a lot of people talking about, we bring the energy. When you guys give us energy, we work even harder to present better and share more. So thank you guys so much for your support, and tweeting this out not only gives you an entry to a giveaway, but helps us out a lot as well. So please go ahead and do this. Let's see if there's any questions. What's the difference between HCR and ADR? HCR and ADR, just one takes into account gaps up and down, and one just considers that day's range. So that's just the simple difference. They'll tell you basically the same information pretty much, but good question. Um, let's see here. Pradeep's webinar is next week, Sai. It's not, it hasn't been, we haven't created the masterclass just yet. Answer that question from Lammy. Thank you guys so much. All right. Very nice. All right. Here we go, guys. Let's keep on going. So what drives 100% moves? We talked about this a little bit. There's the can slim characteristics, which still apply for sure. Based on the work by William O'Neill, we respect him immensely. Ross learned from him personally, which is fantastic. And then Ross shares all the golden nuggets with us, which is great. The can slim characteristics definitely still apply. We probably focus a little bit more on revenue growth than just strictly earnings growth, just based on how the market's kind of changed and adapted. But all these characteristics are really important to review, and we definitely recommend reading this book. It's excellent. Next up, powerful theme. I think this is a really big one that the top traders focus immensely on. What is the leading prevailing theme in the market? For a while, it was AI semiconductors. There were fantastic opportunities during that sector. Now, as the market's entered correction, those names have corrected quite a bit, and it's kind of up in the air what the next powerful theme will be. Biotechs, oil and gas, those type of names are working right now, but that's more of a cyclical theme versus a growth theme. Higher ADR, we've talked about that a little bit. We want beta when we're in a trend. New product and growth, that can be a catalyst for a 100% move. A big base emerging from a sound pattern, a recent stage one turning into a stage two in terms of stage analysis. And then I think this is a big one that people often forget, and it's part of Can Slim, the M, the market uptrend. It's rare, or it's a lot harder for a stock to make a 100% move or a meaningful move when the market's in a correction. You're just fighting you're fighting the risk appetite of institutions. And it's a rare stock that can do that. There's still opportunities, but most 100% moves occur when the market is also in a strong uptrend. Rye, anything that you'd add to this list just comes to mind, high level, what drives 100% moves?
If we add a general one, it could be, float slash uh you know catalyst
Yep.
of a particular stock. So it could be, recently buybacks have had a huge role in a stock, along with, especially if it's like a company that's growing its sales really, really quickly. It's a good cocktail for what institutions really pile into uh, at the moment. So for me, it's, float plays a huge role because I know that the velocity of that stock, which is basically higher ADR, um, yeah, it could get directional either way, up or down, doesn't matter, but it could get directional in a big way.
Yeah.
Um,
What
yeah.
are you looking for in terms of float? What's like a rough guide?
Like if I did the same thing from 2022 to 2024, you'll see the biggest winners have in the range of 100 million to a max 250, 275. Those are your top like 10% of the stocks with the highest percentage moves in the market. So that range seems to be a special range to keep an eye on. Especially we know when things are building, post IPO and what they're doing, etc. Um, as well. So
Perfect. All right, so we're into the last section here, and this is going to be a good one to end it with. You know, as you're talking about technical analysis and the potential of a stock, um, you know, there's really only specific periods in a stock's life cycle that you really want to be focused on potentially finding a momentum trend that's really going to meaningfully move your account. And we've kind of distilled these into three different opportunity zones that we call the IPO boom zone, the growth transition zone, and then the new momentum zone. And by the way, this builds off the work of Mike Webster, the life cycle trade folks as well. We've learned an immense amount from them, and this incorporates kind of everything. But this is, I think, is a really good framework of thinking about it in terms of three opportunity zones. We'll get into each one, but you know, the first occurs shortly after an IPO. There's often a quick phase. We call it the IPO boom zone. Then there's often a substantial correction that we call the IPO bust zone. And then we get the first potential kind of new duration trend when we get a growth transition zone. And this happens when maybe a stock has first started reporting actual earnings. There's a catalyst, maybe the market is turning around as well. And that leads to the potential for a nice trend. Then the last kind of key zone is something that can happen a couple times or over and over again. Like we've seen NVIDIA have many new momentum zones. And that's really after a substantial market correction or bear market, and the stock begins a new stage two uptrend. That's what qualifies for a new momentum zone, where we begin trending above the 10-week moving average again, and the stock breaks above the longer-term 40-week moving average. That starts a new momentum zone for us. And we call these zones because it doesn't just mean it's a buy here, 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 here. It just means this entire zone is where we're going to be looking for setups and edges that we'll talk about and expand on in the next webinar. So these are overall periods and areas that we're looking for opportunities. So getting into the IPO boom zone a little bit more, this is Zim. It had a tremendous IPO boom, many IPO bases. You've got here, here, and a few other trading opportunities at the right-hand side of bases in here. And just this overall trend had a lot of potential. And I think, what was that stock from? I'm blanking on the stock, but basically Shark Ninja, I think that was another one that had an amazing recent IPO boom zone. There's just some stocks that just have tremendous moves right after its IPO. They set up IPO bases like Google, which is the classic one to study, and make tremendous moves. But this zone is often short-lived. And you kind of have to use more aggressive sell rules, more aggressive entry tactics as well, maybe smaller position sizes, because the IPO bust after this move can be pretty substantial. And, you know, sometimes stocks drop 70, 90, 80% during this IPO bust phase and have to prove themselves to the market once again that they're worth the institution's money, and then it'll start a new growth transition zone. But this kind of IPO boom zone, IPO bust zone is pretty much a good area to be trading both to the long side here and potentially in the short side during the IPO bust. The next potential zone to look out for is the growth transition zone. Kathy Donnelly had a great tidbit here. This often lines with when the 200-day moving average is just appearing. And, you know, it's the kind of first setup after the longer term basing process, stage one transition. And this is CrowdStrike here. This is the COVID correction here. And this led obviously to a several 100% move. And CrowdStrike has been a great mature growth stock for trading ever since. So this is kind of the second opportunity and area to be focusing on a stock. It's kind of the first stage two uptrend after this longer period is where you want to be watching for potential setups here. And then lastly, we've got the new momentum zone. Again, this can happen again and again. This is NVIDIA during its recent one. Again, the inverted head and shoulders, but you just have to kind of watch the moving averages and the reclaim. And then it gets above the 50-day moving average and gets above the 200-day moving average. And then this is kind of a launch pad setup and begins a longer-term stage two uptrend, which obviously it's done tremendously well during this period, driven by a new innovation, a new product, AI, a new theme, and that's what kind of creates these new momentum zones. In addition to a longer-term bear market, is the stock will often be part of the leading theme coming out of that bear market. And NVIDIA, of course, was the leader of AI and really capitalize on that opportunity, which creates that trend that we can look for setups, base breakouts, pullbacks to moving averages to enter and join in on the fun. Right. Anything you want to add on, any of these areas, or what you kind of focus on as a trader? I don't know if you look more at the IPO
Yeah,
boom or yeah.
there's a time in the market when there's a risk appetite for IPOs
Yep.
and your younger companies, and there's a time in the market where there's no risk appetite for anything, but traders, let's say, I only trade IPOs, will still force the initiative, right? It's all about, what the market at the end of the day is kind of pushing. Or you'll see a lot of 2019 IPOs right now come into this growth transition zone, right? They based out completely and now they're starting to gap up the right side. That's what Richard's basically pointing to here. They went through the IPO, they went through the IPO bust, and now they're in the growth transition zone, basically. So this type of cyclical nature of newer companies going through these transitions is something that happens again and again in the markets and something really important and something to pay attention to at the end of the day. So last year it was kind of the same thing. Companies from 2017 and 18 started to turn around, were in the markets, matured, were accumulated, etc., based out from their stage one sideways for multiple months. We're going into stage twos. So that's something to keep an eye on. That's something that's happening this year as well.
Yep, perfect. And look at this outside day at the bottom, right at the bottom here. Start of the bottoming process. Then you get an outside day off the range here that forms here even before the space breakout. So again, we went from building blocks today all the way to this high level, much more complex topic. So hopefully this has been very helpful to you guys. And that's pretty much it for today. This is kind of covering the technical analysis foundations that kind of set up everything that we'll talk about in the future, as well as kind of obviously what we dive even deeper into with the Trader's Handbook. So if you haven't yet, we definitely appreciate if you pre-order it. If you're liking what we're talking about today and find this helpful, you're definitely going to love this book. So definitely recommend pre-ordering it. Again, a lot of the bonuses and surprises that we have in store are only reserved for people who have pre-ordered. So definitely go ahead and get your copy if you haven't yet. We've heard from hundreds of traders that they've already picked this up. So definitely grab yours today if you haven't yet. It's 512 pages, 45,000 words. It was a hell of a lot of work, but it was definitely worth it. And I think, if you liked Stan Weinstein's work, William O'Neill's How to Make Money in Stocks, this is very complementary to those subjects and builds off the concepts that are in those books and shows how we apply it and how market wizards apply it and helps you kind of build your own trading system that's unique to you and works for you, right? Those books kind of present their methodologies. We kind of talk about those principles that are shared between all winning trading methodologies and how you can create it for yourself. So that's kind of what this book is all about, helping you build or refine your trading system. So definitely recommend checking this out. If you haven't yet, we worked very, very hard on this and it's worth it. And we're excited to share it with you guys later this year. All right. Also, recommended tool, a lot of what we talked about today, we've optimized and incorporated into DeepView to help make your life easier, find winning stocks easier, find the winning characteristics. We've got Rise HV edges as built-in screens and data points. We've got RMV to help find the tight areas. We've got screens for pullbacks to 21 EMA, 50 SMA. So all those methodologies, we're trying to make it, incorporate here and make this tool as great as it can be. And hopefully you guys check us out if you haven't already at deepview.com. And with that, we'll take a few questions. And again, there's the QR code to order the Trader's Handbook. You can pick yours up today. All right, Rod, do you see any questions here?
I answered most of the Q&A.
Cool.
Wow.
It should be available in India. We'll check with the publisher to make sure it's available everywhere because we've seen a lot of demand for India, Germany as well. We'll double check that it'll be available. And I think they'll be translating it into different languages as well.
Yeah, I believe the Kindle version is available on Amazon India, but we'll check on India and Germany. I think we've seen that quite a
Yep.
bit in the chat.
Kenneth says, this is what has been missing from my education. Definitely appreciate that, Kenneth. Thank you so much. All right. Floyd said she pre-ordered. Thank you so much, Floyd. Floyd, awesome. Thanks, Chris. Appreciate it. Thank you, Steve. Thank you, Mike. Thank you, Arav. Very nice. Awesome. Tom says he just pre-ordered. Thank you so much, Tom. Appreciate it. Oh, Somebody just said they got it from Germany, so that's great.
Ah, works in Germany. Okay.
Perfect. All right, guys. I don't see any more questions coming through. This is recorded and we'll send it out to everybody on the list tomorrow, and we'll publish it to everybody next weekend. So hopefully you guys found this helpful. There's still hundreds and hundreds of you, so thank you guys for sticking with us and spending part of your Saturday with us. We definitely appreciate it, and definitely stay tuned for the rest of the webinars because we're only on webinar 2 of 13. So there's a lot more to cover, a lot more to share, and again, everything that we cover in the webinars is complemented and expanded on in the book. So definitely pick this up if you haven't already. But
The next
yeah,
webinar, by the way, is let's see, sorry. When's the next Saturday,
yeah,
right?
next Saturday.
On the 29th.
Edge,
It will
edges.
cover setups and edges. Yep.
Yep, that'll be a really good one. You don't want to miss that. So stay tuned for your email to be on the lookout for the invite to that. And yeah, thank you guys so much. If you enjoyed this and are watching on YouTube, leave a like and subscribe. And we'll see you guys in future webinars. Thanks, everybody. Take care.
Thanks so much, everyone. Have a good one.